All right, everybody. It is an interesting time to be alive, and we will be going through the 3Q 2025 Amazon MicroStrategy, a lot of different companies' earnings reports today. We had a great time talking about Google / Alphabet and Meta and Microsoft yesterday. So it was a really good opportunity to come back for round two. Obviously, I'm an Amazon shareholder. It is one of my large top 5 positions. So obviously I want to take a look at that. And then I'm also curious to see how MicroStrategy is faring. I think it's going to be a good proxy for a lot of people that are invested in companies like BM&R to potentially look at what the potential looks like associated with those sorts of companies. So very curious. For those of you guys that are joining me on X, we are on YouTube. So if you guys want to participate in the chat or anything like that, feel free to come on over and just look up Real Map Money and you'll be able to find me. So it's going to be interesting. I'm curious to see what ends up happening. Let's get a live tracker for how long we have until market close. And looks like we're pretty dang close for today. Let's see. That's not what I wanted. Okay. We are about a minute left. So let me share this really quick. In the background, while we do that, I don't know what this is, Einstein, what the heck is that? So yeah, we got 50 seconds till market close. Let's take a look at what stocks are looking like, particularly Amazon MicroStrategy, so we can get a baseline ahead. Amazon down 3% going in. MicroStrategy was also down for sure. Yeah, down 7%. So curious to see how these change down to 250 for MicroStrategy. We got 17 seconds till the market closes. And let's check out how the SPY fared due to the backing off of, yep, we're down 1% for the day. Definitely off all-time highs. We were closing in on 6,900 on the S&P 500. So yeah, very curious to see how this persists going into next week or maybe even closing tomorrow. Obviously, people are taking quite a pause. Market is now closed. We have about 18. No, that's not right. Oh, I guess that's until next close. Is 18 hours until next close? No, it should be 24 hours until next close. Is it 17 hours until next open? I guess so. All right. 17 hours till the next open. I find that hard to believe, but I guess it's true. I guess that's true. Yeah, it makes sense, I guess. So anyway, let's see what news comes out with respect to Amazon MicroStrategy. Generally, these guys are pretty dang quick about getting results out. But for now, we'll just go through each of these companies and just see. So the SPY is up, at least retracing back to the mean a little bit. And Amazon 230. I don't know what's happened on Bloomberg. What the Bloomberg terminal is seeing. So we'll have to wait until earnings come out. So 235, 237. So the analysts expected 177.8 and an EPS of $1.58. So we are hoping that it comes north of that based off what we're seeing at 240, up 8% and climbing after hours. It looks like we are going to exceed that. So we have about an hour to the earnings call. $242 or so. Let's just see if there's any news, particularly about the actuals coming out. I don't have a Bloomberg terminal, so unfortunately we had to kind of wait until the actual numbers themselves come out. But in the meantime, so we're continuing to climb, up almost 10% in the after hours. So let's check out strategy, MicroStrategy. This, nothing as of yet for MicroStrategy. But so far, so good for our boys over here. Over at Amazon, almost at 245. I don't know if that might be all-time highs for these guys. Let's see. So earlier this year, we were at 242 and climbing. Almost 245. So I'm very curious to see when the actual numbers come through. 2 Pacific time, 5 Eastern time is when we'll get the actual notes. Let's refresh my page over here and see specifically. Up 42 seconds ago. Let's see. Nope. That's 17 minutes ago. That wouldn't be it. 246. All right, let's go on X. See what X has to say about Amazon Bloomberg terminal, I assume. People talk about Palantir puts. Let's just see Amazon latest. All right, so apparently EPS for Amazon came in at $1.95. Revenue came in at 180. So beat by 1%. That's what's causing the spike up of over 10% in the after hours, up 11% in the after hours. I'm curious where that's coming from. Is that coming from cloud? Is that coming from better than expected e-commerce? EPS as a whole up 36% year over year. Those are positive numbers we want to see. Revenue as a whole, 13% year over year, 16% on the EPS quarter over quarter. So not only 36% year over year, but 16% quarter over quarter. That's generally for the third quarter. We generally see more in the second quarter because sales are generally weighted towards the end of the year. Revenue up 7% quarter over quarter. AWS looks like a $600 million beat in terms of revenue. It's supposed to be 32.4. It ended up being about 33. So bien, muy bien quarter for our friends at Amazon. Good for me because I just picked up some shares. So MicroStrategy, did they report earlier today, or I thought that was supposed to be after the bell? Yeah. Yeah, it's supposed to be after hours for the strategy. So nothing as of yet for MicroStrategy, but we'll do a search for that. MicroStrategy Investor Relations. That's Microsoft. MicroStrategy Investor Relations. So that's also at 5 p.m. Why you got to do this to me? Why? They're doing it over Zoom. Investor Career Analytics. Interesting. All right, let's see now. Still nothing on the quarterly results for Amazon in terms of slide deck. How are we doing on the price? Still 245. Talk about a win. All 52-week highs. Potentially all-time highs. Yeah, all-time highs. Amazon. Massive revenue beat. 180B versus 177B on the path to 1T annualized revenue. All right. All right, we're retracing a little bit down to 244. Hey, you can see my little baby position that I have in Robinhood. Little 13 shares. Did I transfer? So I'm taking advantage of the transfer. Actually, I'm trying to remember what I did transfer. I think I transferred my next decade, and I transferred my venture global. So that should eventually come over here into Robinhood. All right, so let's see. We are live on Twitch as well. Appreciate the Twitch gang showing up. We got Jimaza. What's going on? Rocket Lab is on sale. I don't even know. I think I saw it at $63. So we'll see. When Moon, when Lambo? Good question. These are the questions we need answers to. 24% beat. We got Sechin looking good. I appreciate that. Do I hold BMNR? No, I can't afford it. I am poor. So no BMNR for your boy Mateo Mula. Do you buy Amazon now? That's up to you, man. I'm holding it. I'm buying more. AWS. There it is. Yeah, that's really up for you to answer. Like if you're looking for a short-term investment or something, I really can't really understand. Apparently Coinbase, let's see what Coin is up to. I'm really hoping that some of these crypto stocks. Somebody said big beat for Coin, but I'm not seeing that show up in the numbers. Down 5%. I'm hoping that with crypto, you have the opportunity in the latter half of next year to potentially pick up at a discount. When are these guys going? They have a time when they're reporting. It says after hours. So Amazon, man, doing good. Let's see. What other earnings calendar do we have? Earnings calendar. What else do we have today? It's a big day. We have Apple, obviously. Yeah, I'm dumb. I'm so preoccupied by how's Apple looking. All right, a little bit, but I feel like that probably means they haven't even released yet. Apple earnings. They were pleased fourth quarter, so they topped 4 trillion. Apple EQ, 2 p.m. 5. Everyone is at 5 p.m. Man. Apple Investor Relations. Here we go. See, like. Give me the numbers. These people in there, they're not wanting to give me the numbers. That's July 31st. Let's see. So that's their third quarter. We want the fourth quarter. I hate how they talk. Like, I hate how different companies, like, it should be standardized. Like, depending on what company you're on. All right, let's check back on Amazon, see if their slide deck is out. Slide deck is still not out. Oh, no, slide deck is out. Earnings release. Let's just read through the earnings release as a whole. For the Zon. All right. Net sales increased 13% year over year to 180 billion, compared with 158.9 billion in the third quarter of 2024, excluding 1.5 favorable impact from year over year changes in Forex. Net sales increased 12%. So good. North America 11% year over year to 106. Insane. International segment increased 14% to 41 billion, or 10% if you exclude Forex. Also insane. AWS increased 20%, a little slower than I would like, but even still, like, it's $130 billion run rate. Pretty good, pretty healthy comparatively to Azure, which is closing in on 200. So obviously they're showing up. I mean, I don't think that they're charging as much as Azure is. But I think the cloud piece for Azure also includes a little bit of 365 subscriptions and stuff like that. So it might be a little bit confusing. Operating income was 17.4 billion in the third quarter compared to 17.4 in the third quarter. So flat in terms of that, which includes two special charges, 2.5 related to legal settlement with the FTC, and 1.8 in terms of severance costs related to the role eliminations, which I'm assuming is what they rolled out the other day when they talked about the 14,000 layoffs or whatever they were going to have. North America segment operating income, was 4.8 compared to 5.7. Excluding the 2.5 billion, it would have been 7.3. So it would have went from 5.7 to 7.3, which also includes the severance costs. International was 1.2, which is good compared to the 1.3. These also include severance costs. I'm curious to see how much of that impact was due to that. So would it have been 1.4, 1.5? Because obviously you had pretty decent growth, 14% revenue growth, but obviously you're now flat on ops income. So a little bit concerning. AWS was 11.4 billion compared to 10.4 in the third quarter. This includes the estimated severance costs as well. So net income as a whole, 21.2 billion in the third quarter, or $1.95 per share, compared to 15.3 or $1.43 in the third quarter. So huge upbeat. Third quarter 25 net income includes pre-tax gains of 9.5 from our investments in Anthropic. So I guess a write up in terms of the value of Anthropic. Ops cash, Jesus Christ. See, this is where I'm looking at, right? This is where I get excited about Amazon. So you're talking like on a net income basis, annualized right now, you're talking about 80 billion, right? So I get that. That's awesome. But then you get to the ops cash. The TTM ops cash increased 16% to 131 billion compared to 112 comparatively last year. So that's a big increase. What can you do with $131 billion? That's huge. So free cash flow decreased 14.8, driven primarily by the increase in purchase of properties, CapEx, basically net of proceeds from sales and incentives. This compares to free cash of 47.7. Jassy says, we continue to see strong momentum and growth across Amazon as AI drives meaningful improvements in every corner of our business. AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year. We continue to see strong demand in AI and core infrastructure, and we've been focused on accelerating capacity, adding more than 3.8 gigawatts in the past 12 months. In stores, we continue to realize the benefits of innovating in our fulfillment network, and we're on track to deliver Prime members at the fastest speeds ever again this year. Expand same-day delivery of perishable groceries to over 2,300 communities by year end, and double the number of rural communities with access to Amazon's same-day and next-day delivery. Highlights include adoption of Trainium, custom AI chip, interesting to hear, and multiple billion-dollar business that grew 150% year over year. Sorry, quarter over quarter, not even year over year. That's pretty interesting, but you don't know what the denominator is on that, right? So where did they start from? Was it like $50? That's interesting, but it says multi-billion-dollar business. Launch Project Rainier, massive AI compute cluster containing 500,000 Trainium 2 chips to deploy Anthropic's leading Claude AI models. Ultra servers with NVIDIA Grace Blackwell super chips designed for training and deployment, added 3.8 gigawatts in the past 12 months, more than any other cloud provider. New foundation models of Amazon Bedrock, open weights for OpenAI, DeepSeek, and Qwen 3, as well as Anthropic's Cloud Sonnet, Cloud Opus, and Cloud Haiku. Announced a number of Amazon EC2 instances for general purposes, Graviton 4. Wow, they're going pretty big into some of these build your own chip sort of things. Interesting to see. Expanded access to Cairo and agentic coding. Cairo, an agentic coding integrated development environment that brings clarity through spec-driven development. More than 100,000 developers jumping in during the first days of preview and doubling since. Quick Suite Agentic AI. So what happens? Turn month-long projects into 80% time savings, 90% cost savings. Let's just see. Transformers save 700,000 hours of manual integration, 335 developers years of work year to date. Lots of good material. Added AWS region in New Zealand. More than 10 availability zones and 3 more regions. Signed agreements with Delta, Volkswagen, Fox, ServiceNow, Qantas, U.S. General Administrative, SAP, Lululemon, Live Nation. Number of rural communities with access to same-day delivery by 60%. Expanded same-day delivery of perishable groceries to 1,000 cities in the U.S. Expanding to 2,300 locations by the end of 25. Interesting. NBA on Prime. I thought that was interesting. So they debuted that in more than 200 countries. 1.2 viewers during the season open doubleheader. Not bad for the first time. Kicked off the 4th season of Thursday Night Football. Has there really been 4 seasons already? Jesus. Averaging 15.3 million viewers, the best on TNF for any network in a decade. 16% increase year over year. Based off the last season's 7-game average. That's wild. Here you go. This is something I'm curious about. Expanded Project Kuiper fleet to 150 plus satellites demonstrated industry-leading downlink speeds of 1+ gigabyte per second. And announced commercial agreements with JetBlue, Australia's national broadband network, Kazakh Telecom, which is the leading telecommunications provider in Kazakhstan. Begin offering Zoox robo-taxis in Las Vegas. I saw that. Becoming first fully autonomous ride-hailing service and purpose-built robo-taxi. And they announced Washington, D.C. as the 8th testing location soon. Average hourly pay in the U.S. for $30 an hour, including elected benefits. Future Ready 2030, $2.5 billion commitment to expand access to education and training for at least 50 million people in the broadening workforce. Let's see. Hundreds of thousands of seasonal jobs this season, including 250,000 in the US, 150,000 in India, and thousands across Australia, Canada, Europe. Insane. So the 4th quarter guidance. Jesus Christ. How's the stock doing? Stock's got to be doing good, right? Let's check on it. Stock's got to be doing gangbusters, right? Oh my God. Oh, that's Apple. I'm an idiot. Sorry, I jumped the gun. But still, let me share. But still, so sorry. So you're seeing the 244 on the screen, right? I flicked back to, I'm an idiot, right? Let's just preface this. I flick back and I see this 272 and I see the A, right? And I didn't read the whole thing, but I saw the A and I see the 272 and I'm like, Jesus Christ, I'm retiring tomorrow, right? Like 273. It's not that much money, but I mean, Apple is showing up, so I'm curious. We're going to check this out in a second. But 244, still excited. We were in the 230s, so to be up $10 a share, it's pretty good. Obviously, we've taken a dip today, but overall, looking pretty promising in that respect. So there's that. But let's go back to reading the rest of what we have to see for fourth quarter earnings guidance, which I was 206 to 213 billion is insane. So that's going to grow between 10 and 13%. Granted, the fourth quarter is always their largest quarter, but I'm just like, the fact that we're getting into the 200 billions at this point means like we're getting closer. Like, I think a lot of people like $1 trillion. Like, there's no way they're going to get to that. But they're going to be making $200 billion in a single quarter. And they were just like, if you average the third and fourth quarter from what they just delivered at 180 billion in this, you're getting to 195 billion dollar run rate in the third and fourth quarters. Granted, the first and second quarter need to catch up, but I mean, that's just a lot, right? So operating income expected to be 21 and 26 billion. So it's 21.2 billion in the fourth quarter of 2024. So assumes no additional business acquisitions, restructurings, legal settlements, etc. So we will be listening to this call for sure in about 36 minutes. I'm curious now if Apple has provided anything. All filings, quarterly filings. No quarterly filings. Let's see. Listen to conference call. They have to have released like a Apple fourth quarter 2025 news release. So they did announce it. Have they not put it out yet? That's July. Dang. Really not? Guess not. They really haven't let it out of the bag yet. So, all right, we'll give that another 5 minutes or so. Maybe they're going to release it here in 5 minutes. Let's check on some of these other stocks. Where am I at here? Let me go back to my Robinhood. In fact, while we're at it, let's just pull up Webull. So yeah, Apple, let's see. It looks like it's moving in the right direction. So I assume at this point, the earnings are probably out on Bloomberg. Let's check X. I need to do a better job about closing out some of these things. Let's see what's anything on Amazon or CNBC. Anything associated with any of these yet? No. Let's check Apple. All right, so we got people talking about Amazon. Yeah, people are just here. Let's move it over to this. People saying, "Why are you make me wait until 4:30?" People just waiting. Amazon again, still waiting for Apple. Somebody said they bought 8.7 million and 11 DTEs. Okay, well, we'll wait till 4:30. Where is? There it is. So I mean, it's looking okay. It doesn't look awful in terms of what it's waiting on. Let me share this screen. Entire screen. There we go. Let's see. Netflix announced a split. Did Netflix report today? I'm sorry. I'm off the beaten path, guys. But Netflix announced a split. They're up 3%. So let's see. Let's take a look. You can't really see it after hours, I don't think. Maybe you can. No, you can't. I thought you could see it after hours. The movement after hours. Can you not? Oh, you can. There you go. It's up a little bit. Makes it look more drastic from 1,088 to 1112, so up 3%. Orders coming in. Yeah, orders coming in for that. Not horrible with their announcement of a split. Let's go back to Apple. Still nothing, but it looks like it's trending down. It looks pretty erratic. Let's see. I wouldn't be surprised. You start to see some numbers come through. Ooh, there it is. It's going down in real time. In real time. No bueno. Only 1.5%. It looks more drastic on the screen. Only 1.5%. Not a big deal. At least for now. So let's keep refreshing. Apple. Let's see up top if they give anything. Half an hour till earnings report, but let's just refresh on Apple. Query, latest. So apparently Apple beat by 12 cents. Here we go. All day stocks. So the beat on revenue looks like 102.5 versus 102.2. EPS of 185 versus 177. Services 28.75 versus 28. So I'm assuming it's based off of some sort of forecast issue. Maybe Greater China. Maybe that's what it is. 16.5 is what they're kind of expecting versus 14.5. So Apple beat on EPS, but China sales came in below. So it's likely it. Stock's trading about 1.5%, 2% down. Not horrible. I mean, you think about it, it's still a $4 trillion company overall. So it's not exactly awful. We will not be covering, I don't believe, we will not be covering Apple's earnings call. Will we be following Amazon personally? That's at least what I'm expecting to most on. Let's see if MicroStrategy has released any particular details. Nothing yet, just the live webinar. No presentations as of yet. Let's see, did Netflix actually release? I thought that they released the other day. I don't care about that. Yeah, they released last week. That's what I thought. But they just announced a split, so good for them. Who else is out there today? Eli Lilly, MasterCard, Shell reported this morning. Stryker, Total, BBVA. Who else is reporting? Coinbase this evening. So maybe we can take a quick look at Coinbase. We have half an hour or so until. So MicroStrategy is supposed to be not making money this quarter. For public services, I have other reasons to be curious about that one. We have Vail. A lot of different companies are supposed to report today. Lots of companies supposed to report today. Yeah, I'd say the ones that we're most concerned about are Apple, Amazon, both of which reported. In my opinion, Apple did okay. Amazon, wow. I mean, Amazon just out of the park. So I'm excited to look at the investor deck. I'm excited to hear. They were talking a big game. You know what I didn't see in that initial piece that they shared for Amazon, that news report? I didn't see anything about the health care. They've been focusing a little bit. Sorry, my hair is out of control. They didn't say anything about the healthcare. Maybe they'll talk about it. And I've also, somebody said in the chat, looking at an NVO, I've been wondering when the sell-off is done for NVO myself. And so I'm curious. Eli Lilly looks, they said that they were reporting today. Let's check out how they're doing. Eli Lilly was up for the day. They reported this morning. Up to $8.43 a share, which is insane. Continue to hold on, right? Continuing to hold on. And unlike, check this out. This is insane. Unlike Novo Nordisk. Novo Nordisk is down at $50, and it was at a peak of $142. They just fired their chairman. So I'm very curious. At what point do you step in, if at all, right? I mean, there's always the question of, don't catch a falling knife, right? There's always that question. Always that question. But let's check to see if MicroStrategy at this point. Their call's in 20 minutes. Okay, so it looks like they're up. Looks like they're up. Let's pull up strategy MSTR on Webull. And let you guys view that. While on this side, I look to see if MicroStrategy is released. So it's a Zoom call. don't want to join. Oops. Hopefully there's nothing proprietary on here. Nope, nothing proprietary. Doesn't look like. All right, so that's at 4 p.m. my time, so 5 p.m. We won't be watching strategy. I'll say that much. We'll be following Amazon. I will want to eventually listen to Strategy's call, though, for certainty. But I guess we will have to go to X to see what came out for MicroStrategy. All right, one's in the chat. If this is your first time being here on the stream, appreciate the people watching on X. There's been like 800 people that have clicked it on X. Please feel free. Holy crap. MicroStrategy. Here we go. Oh, they have their earnings call on YouTube too. That'd be dope. All right, so let's take a look and go through Strategy's earnings really quick. Thank you for the guys being here. I appreciate you. I know you can be anywhere, right? I know you can be on Tanner's stream, you can be on mine. In fact, me even saying that, or sorry, on midstream, you can be on Tanner's. I'm sure Steven Fiorillo is still alive. So yeah, very curious. In fact, let's see. Is Hot Steve still on? No, just Amit. Amit and Steve went on to Amit, so it's good. No problem. And then you got Hot Tanner. That's good. That's fine. I'm good. They do a phenomenal job. So net income of $2.8 billion, diluted EPS of $8.42 for Strategy, 3.9 in operating income, 2.8 in net income, $8.42 in diluted EPS. The Bitcoin highlights: they now own 640,000 at a cost of 47, or 74,000 of Bitcoin. So their Bitcoin yield for 2025 year to date is 26%, 12.9 billion gain achieved in 2025 year to date. So that means their operating income of 34 billion, net income of 24 billion, diluted EPS for the year of $80 a share. I assume that all is because they can claim now Bitcoin as profit, whereas before I don't think they could. Okay. Look how many ticker symbols. Jesus. The largest corporate holder of Bitcoin in the world and the world's first Bitcoin treasury company today announces their financial results for the 3-month period ended September 30th, 2025. In the third quarter and into October, Strategy continued to strengthen its position as the world's leading Bitcoin treasury company, increased to 640,808 Bitcoin, have raised $20 billion year to date through our robust capital markets platform, remain fully aligned to our STRC guidance framework, and have announced 25 basis points increase and the STRC dividend rate to $10.50 for November. 10.5% for November. We're actively laying the groundwork for credit securities in the international jurisdictions, positioning Strategy to become a dominant credit issuer globally. With the momentum, we are reaffirming our strategy and full year targets of 20 billion Bitcoin gain and 30% BTC yield. Strategy generated third quarter 2025 operating income of 3.9 billion, net income of 2.8, and diluted EPS of $8.42 per share. Our second consecutive quarter of significant positive earnings built on the strength of Bitcoin balance sheet and capitalization of the company on digital credit. We generated Bitcoin yield of 26% and a Bitcoin dollar gain of $13 billion year to date. And we are reaffirming our full year guidance for operating income of $34 billion. Net income of $24 billion, and diluted EPS of $80 per share. Based on a Bitcoin price outlook of $150,000 at the end of the year. So they're basically saying between now and the end of the year, Bitcoin's going to raise by about 30%, because we're at about 105 to 110,000 as of right now. Strategy has built over $71 billion of transparent, scalable, and homogeneous collateral, enabling us to being the leading issuer of digital credit with broad suite of securities across yield and volatility spectrum. Our digital treasury business model allows us to create tax-efficient credit structures with return on capital dividends, offering superior yield compared to a traditional credit. S&P recently issued a B- credit for Strategy, which we believe will be substantially expand the addressable market for their securities. We continue to innovate with new credit instruments. Together, we believe these developments will drive greater Bitcoin application to the benefit of our common stockholders. MicroStrategy still $265. So let's see. Is there anything interesting? So software highlights, only 130 million, 10.9% increase year over year. Subscription revenues were 46 or 65% increase year over year. Product licenses were 63 or 69% year over year. So the underlying software business is doing well. Software business was 90.7 billion, representing a 70% gross margin compared to 81 or a 70% gross margin for the third quarter of 24. 26% yield to date for Bitcoin compared to a target of 30% for the year at $150,000 Bitcoin price. They've achieved a Bitcoin gain of 116,000 year to date. The dollar gain is 12.9 billion year to date, based off 110,600, compared to the full year target of 20 billion. Excuse me. Company's digital assets of approximately 640,000 Bitcoins with an original cost basis of 47 and market value of 71 reflects an average cost of 74,000 and a market price of 110,000. So this is the summary. So common stock ATM. So they issued 2.2, looks like, or 5.7 million shares. They have about 16 billion that they can remain. The STRK company did 152 million through the issuance of 1.4 million of its 8% perpetual between October 1st and October 26th. Net proceeds of about 23.8. They have about 20 billion remaining for that. STRF. This is a 10%. Um, 1.7 million remaining for the issuance under that. STRD is a 10%. 4.1 billion for that. And then, excuse me. In the quarter, they IPO'd STRC, which gave them 2.5 billion. So there you go. This is interesting. So Strategy is reaffirming its rules-based monthly dividend recommendation framework for STRC. Strategy's current intention is still discretion for volume-weighted average price of STRC for the 5 trading days prior to the last trading day. So if it's below $95, they recommend a dividend rate increase of 50 basis points for the next period. If it's between 95 and 98, they recommend a 25% basis point. If it's between 99 and 101, no change. And if it's above 101, they'll decrease it. Interesting. It's cool. So below a 2.5x MNAV, strategy will tactically issue common equity below. This is pretty cool because you're giving the framework, right? Strategy will tactically issue. I just want to make sure I'm sharing. I'm just double check everything's good. Okay, StreamYard, cool. Below 2.5 MNAV, pay interest on debt obligations, fund preferred equity dividends deemed advantageous. If it's between 2 and 4, they'll issue to equity to acquire Bitcoin. And above 4. Interesting. And this is, we got 12 minutes until the Amazon call. So let's see how Amazon is faring. You have MicroStrategy kind of coming down now. So let's see how Amazon is faring. It is still running, ladies and gentlemen. Let me pull it up. Amazon is still running. $249 a share. Will it break 250? Will it break 250? Interesting. A lot of people probably thought that my $1,000 a share, I mean, obviously we're only at 250, right? But people probably saw my tweet yesterday, $1,000 a share, and they're like, Matt's an idiot. And you're right, I am. But in this case, not too horrible. Not too horrible. All right, so what do you guys think? You guys buying? What are you doing? You continuing to buy the dip on some of these stocks? Are you buying the all-time highs on Amazon? Amazon under $300 is cheap. There you go. Let's see. Riot. Somebody's saying Riot. Double beat. Up 3%. Check out Apple. Oh, Apple did a turnaround, ladies and gentlemen. Apple did a turnaround. What in the EC? What in the EC will they talk about that had this turnaround? Did people just digest the China news and they said, you know what, China's not that big of a deal? Is there something secondary? Let's see. Because those were just preliminary numbers, right? But maybe something actually in. Still no data. Oh, nope, here it is. Press release. So we have 9 minutes, ladies and gentlemen, before we actually start the call for Amazon. We're studio. There we go. Come on. There we go. All right. September quarter records for the total company revenue, iPhone revenue, service revenue, new all-time highs. So announced the financial results at a September 27, 2025. Company posted quarterly revenue of 102.5, up 8% year over year. Diluted EPS was $1.85, up 13%. Buybacks helped that. Apple's proud to report a September quarter revenue record of 102.5, including September quarter revenue record for iPhone, an all-time revenue record for services. September, we were thrilled to launch our best iPhone lineup ever, including iPhone 17, 17 Pro, Pro Max, and iPhone Air. In addition, we launched a fantastic AirPods Pro 3 with all new Apple Watch lineup. When combined with the recently announced MacBook Pro and our iPod Pro with Powerhouse M5 chip, we are excited to be sharing our most extraordinary lineup of products ever as we head into the holiday season. September quarter results capped off a record fiscal year with revenue reaching $416 billion. Not bad, as well as double-digit EPS growth. And thanks to our very high levels of customer satisfaction and loyalty, our installed base of active devices also reached new all-time highs across all products categories and geographic segments. The declared dividend of 26 cents per share is payable on November 13th. The people that hold the stock as of November 10th. Is that really it? What the F? I was expecting... Maybe it's because it was just the best Apple iPhone sales ever? Is that really it? I mean, I don't know, including a September quarter revenue record. Are they releasing one every September? Is that the game? We're up 4.3% on Apple. Interesting. All right, let's run through who's all here. 1,000 people or so have clicked on X. I appreciate the 47 of you guys live here on YouTube. So let's see. We got DJ. We got Natural Grind. We got Uzi. What's going on, my man? DJ. We got Ricardo. We got Alvarado. Top Secret. Mr. Premium of the Optional Analyst. T.Y. Vester. You Tyranny. Wingthamo. No, I'm not wearing a suit. Just a blazer. Is Rocket Lab going to zero? Probably, if you're mentioning it. Bought more Amazon at $216 a couple weeks ago. Buying more PayPal and Nike now, and I like the software stocks here. Adobe, Salesforce already got big positions in both. I like Meta here, but you don't own it. I'm a baller. You know, I bought my Amazon. Sorry, I bought my Meta yesterday. You know, big money. Big Mateus Mula. Oh my goodness. I didn't check Facebook today. Microsoft, rather. Not Microsoft, Meta. Check this out, ladies and gentlemen. You probably already saw it, so apologies. Check out this bad boy. It went down to 650 at one point. That's insane. That's awesome. Talk about a breather. Love that. Bought a few hundred shares of Amazon before earnings. Jesus, congratulations, brother. Yeah. Like, dude, I shit you not. I was sitting at lunch like on Tuesday or something with some people, and I moved to a different department a couple years back, and so lately I've been sitting. I report through a boss in a different country, so you know, I used to report in Texas, but now I report through a different country, and but I sit here in Houston, and was just like, you know what? I miss some people. Like, let me go up to my old floor, you know, some of the old people. Like, Matt, like, you're doing really well. Like, what's your secret? And I'm like, I don't sell great companies. They're like, what? Like, flabbergasted. I'm like, yeah, like, when was the right time to sell Amazon? When was the right time to sell Microsoft? When was the right time to sell Google? And they're like, so I'm like, yeah, like, Palantir's killing it. Rocket Lab, they're going to kill it if they haven't. I mean, they already are killing it. The numbers just need to catch up a little bit. But like, you're buying these great companies. It's like, when's the right time to sell them? The answer is never, right? They continue to perform. And when they stop performing, right, and things actually go the wrong direction, like if somebody actually starts eating market share away from Amazon in terms of e-commerce, like, okay, cool. Like, but you saw, like, they just absolutely destroyed it. They killed it. Like, so until that happens, like, I feel like it just doesn't make sense. So, like, I think so many people make it so complicated, when it does not need to be. But let's get ready, ladies and gentlemen, for the Amazon Investor Relations uh, third quarter. Sorry, I keep getting mixed up with our friends. Presentation is out for Amazon. Let's get the webcast going. Let me just make sure I'm not sharing my screen. Okay, good. Let me register for the call. All right, ladies and gentlemen. Let me switch screens. Yeah, very curious to see. Let's see. Let me type the slides over here on the other screen. Here we go. Actually, before I hide this, let me just make sure. Yeah, we're good to go. We're fine now. And let me make sure. Do you have a closed caption on here? Oh, all right. I know it is light right now, but we will see. This is it. Enjoy the ride. I agree. Companies. Warren Buffett was right. I mean, a lot of people are like, "Oh, like fuck Warren Buffett he doesn't know." It's like he still said buy great companies, right? I mean, just because it's software and it's not something he buys doesn't mean his stuff doesn't work. Like buy companies, even if they're slightly overpriced, and yeah, was it 10 for 1? I never asked. Never asked. So it's good to know. Um, Somebody said it split. I mean, I'm not saying like, oh, I didn't ask like why you bring that up. I meant like somebody said it split, but I didn't ask what it split to. So 10 for 1, that's good. I think that'll put some downward floor on the stock price, right? You have a little bit more liquidity. People can afford to buy more shares, or at least perceive to buy more shares at $112 a share. Well, if you bought Rocket Lab, BM&R, and Hood, well, Rocket Lab and Hood, it seems like you're probably doing well. DM&R, not so much. All right, let's tune into the call.
Good day, everyone, and welcome to the Amazon.com third quarter 2025 financial results teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded, and for opening remarks, I'll be turning the call over to the Vice President of Investor Relations, Mr. Dave Fildes. Thank you, sir. Please go ahead.
Hello, and welcome to our Q3 2025 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results, as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2024. Our comments and responses to your questions reflect management's views as of today, October 30th, 2025 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions, tariff and trade policies, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now I'll turn the call over to Andy.
Thanks, Dave. We saw strong growth across our business in Q3, and we're reporting $180.2 billion in revenue, up 12% year over year, excluding the impact from foreign exchange rates. Operating income was $17.4 billion, but would have been over $21 billion if not for two special Q3 expenses: $2.5 billion for an FTC settlement and $1.8 billion for estimated severance costs. Trailing 12-month free cash flow was $14.8 billion. I'll start with AWS. AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year, our largest growth rate in 11 quarters. It's worth remembering that year-over-year percentage growth is a relative term. It's very different having 20% year-over-year growth on a $132 billion annualized run rate than to have a higher percentage growth rate on a meaningfully smaller annual revenue, which is the case with our competitors. Backlog grew to $200 billion by Q3 quarter end and doesn't include several unannounced new deals in October, which together are more than our total deal volume for all of Q3. AWS is gaining momentum. Customers want to be running their core and AI workloads in AWS, given its stronger functionality, security, and operational performance. And the scale I see in front of us gives me significant confidence in what lies ahead. I'll share a little more detail on why. It starts with AWS having much broader infrastructure functionality. Startups, enterprises, and governments want to move their production workloads to the place that has the broadest and deepest array of capabilities. AWS has more services and deeper features within those services than anybody else and continues to innovate at a rapid clip. These are key building blocks for anything that customers want to create, and they're a big part of why Gartner has named AWS leader in its Strategic Cloud Platform Services Magic Quadrant for 15 consecutive years. We're bringing this same building block approach to AI. SageMaker makes it much simpler for companies to build and deploy their own foundation models. Bedrock gives customers leading selection of foundation models and superior price performance to deploy inference into their next generation applications. A lot of the future value companies will get from AI will be in the form of agents. AWS is heavily investing in this area and well positioned to be a leader. Companies will both create their own agents and use agents from other companies. For those building their own, it's been harder to build than it should be. It's why we launched Strands, to make it much easier to create agents from any foundation model that builders desire. For companies who successfully built agents, they've hesitated putting them into production because they lack secure, scalable runtime services or memory or observability built specifically for agents. It's why we launched Agent Core, a set of infrastructure building blocks that allow builders to deploy secure, scalable agents. Ericsson used Agent Core to deliver AI agents across their workforce. Sony used it to build an agentic AI platform with enterprise-level security, observability, and scalability. And Cohere Health is using Agent Core to deploy agents that will reduce medical review times by up to 30 to 40%. Agent Core's SDK has already been downloaded over 1 million times, and our builders are excited about it. It's an enabler. Companies will also use others' agents, and AWS continues to build many of the agents we believe builders will use in the future. For coding, we've recently opened up our agentic coding IDE called Kiro. More than 100,000 developers jumped into Kiro in just the first few days of preview, and that number has more than doubled since. It's processed trillions of tokens thus far, weekly actives are growing fast, and developers love its unique spec and tool calling capabilities. For migration and transformation, we offer an agent called Transform. Year to date, customers have already used it to save 700,000 hours of manual effort, the equivalent of 335 developer years of work. For example, Thomson Reuters used it to transform 1.5 million lines of code per month, moving from Windows to open source alternatives and completing tasks 4 times faster than with other migration tools. Customers have also already used Transform to analyze nearly 1 billion lines of mainframe code as they move mainframe applications to the cloud. For business customers, we've recently launched QuickSleep to bring a consumer AI-like experience to work, making it easy to find insights, conduct deep research, automate tasks, visualize data, and take actions. We've already seen users turn months-long projects into days, get 80% plus time savings on complex tasks, and realize 90% plus cost savings. And for contact centers, we offer Amazon Connect, which creates a more personalized and efficient experience for contact center agents, managers, and their customers. Connect has recently crested $1 billion annualized revenue run rate, with 12 billion minutes of customer interactions being handled by AI in the last year, and is being used by large enterprises like Capital One, Toyota, American Airlines, and Ryanair. These are real practical results for customers, and there are many more examples like them. Because of its advanced capabilities, security, operational performance, and customer focus, AWS continues to earn most of the big enterprise and government transformations to the cloud. As a result, AWS is where the preponderance of companies' data and workloads reside, and part of why most companies want to run AI in AWS. To enable customers to do so, we need to have the requisite capacity, and we've been focused on accelerating capacity the last several months, adding more than 3.8 gigawatts of power in the past 12 months, more than any other cloud provider. To put that into perspective, we're now double the power capacity that AWS was in 2022, and we're on track to double again by 2027. In the last quarter of this year alone, we expect to add at least another 1 gigawatt of power. This capacity consists of power, data center, and chips, primarily our custom silicon Trainium and NVIDIA. We've recently brought Project Rainier online, our massive AI compute cluster spanning multiple U.S. data centers and containing nearly 500,000 of our Trainium 2 chips. Anthropic is using it now to build and deploy its industry-leading AI model, Claude, which we expect to be on more than 1 million Trainium 2 chips by year-end. Trainium 2 continues to see strong adoption, is fully subscribed, and is now a multi-billion-dollar business that grew 150% quarter over quarter. Today, Trainium is being used by a small number of very large customers, but we expect to accommodate more customers starting with Trainium 3. We're building Bedrock to be the biggest inference engine in the world, and in the long run, believe Bedrock could be as big a business for AWS as EC2. And the majority of token usage in Amazon Bedrock is already running on Trainium. We're also continuing to work closely with chip partners like NVIDIA, with whom we continue to order very significant amounts, as well as with AMD and Intel. These are very important partners with whom we expect to keep growing our relationships over time. You're going to see us continue to be very aggressive investing in capacity because we see the demand. As fast as we're adding capacity right now, we're monetizing it. It's still quite early and represents an unusual opportunity for customers in AWS. I'll now turn to stores, where the team continues to deliver and innovate for customers across our key priorities: selection, low prices, and convenience, particularly fast delivery. We're offering 14% more selection since last quarter from popular brands like The North Face and Charlotte Tilbury, and we've added hundreds of thousands of items from popular brands this year. Everyday Essentials continues to grow quickly, and year-to-date is growing nearly twice as fast as the rest of the business. We continue to make it easier for customers to order low-priced perishable groceries from Amazon, and customers in more than 1,000 cities and towns now can shop fresh groceries alongside millions of Amazon.com products with free same-day delivery. This is a game changer for customers who can now order milk alongside electronics, check out with one cart, and have everything delivered to their doorstep within hours. The team also invented a new Add to Delivery button that lets customers add items to previously scheduled orders, and it's been used more than 80 million times since launch, and it just launched. It's an example of one of those seemingly simple but powerful innovations that make customers' lives easier. We remain committed to staying sharp on price and meeting or beating prices of other major retailers. In July, we had our biggest Prime Day event ever, with customers saving billions of dollars across more than 35 categories. We continue to break records on speed. We're on track to deliver at our fastest speeds ever for Prime members globally once again this year, and we've started rolling out 3-hour delivery in select U.S. cities. We're also continuing to invest in infrastructure to speed up rural deliveries and serve more customers in more communities. That includes committing over $4 billion to expand our rural delivery network across the U.S. These are small towns where people want fast delivery, but where other companies have been backing out and reducing service. In contrast, we've already increased the number of rural communities with access to our same-day and next-day delivery by 60%, reaching roughly half of the total communities we plan to expand to by the end of the year. The stores team is also innovating rapidly with AI. For example, Rufus, our AI-powered shopping assistant, has had 250 million active customers this year, with monthly users up 140% year over year, interactions up 210% year over year, and customers using Rufus during a shopping trip being 60% more likely to complete a purchase. Rufus is on track to deliver over $10 billion in incremental annualized sales. Here are the highlights. Our generative AI-powered audio feature that combines product summaries and reviews to make shopping easier has expanded from hundreds of products at launch to millions of products, and millions of customers have used it, streaming almost 3 million minutes. And Amazon Lens, an AI-powered visual search tool that lets customers find products with their phone's camera, a screenshot, or a barcode, now includes Lens Live, which instantly scans products and shows real-time matches in a swipeable carousel. Tens of millions of customers are using Amazon Lens each month. Moving on to Amazon Ads, we're pleased with the continued strong growth, generating $17.6 billion of revenue in the quarter and growing 22% year over year. We see strength across our broad portfolio of full funnel advertising offerings that helps advertisers reach an average ad-supported audience of more than 300 million in the U.S. alone. We also continue to be excited about our demand-side platform, Amazon DSP, which lets advertisers plan, activate, and measure full funnel investments. Last quarter, I mentioned our partnership with Roku, and we've built on that with a partnership with Netflix, providing advertisers using Amazon DSP with direct access to Netflix's premium ad inventory. We announced integrations with Spotify and SiriusXM. With Spotify, we provide advertisers with direct programmatic access to a global audience of more than 400 million monthly ad-supported listeners. And with SiriusXM, brands can reach 160 million monthly digital listeners across services like Pandora and SoundCloud. And we're excited about the advertising opportunity around Prime Video Live Sports. Live Sports got a lot of interest from advertisers in upfront negotiations for 2025-26, and we exceeded our own expectations for upfront commitments with significant growth across the board. Finally, we're continuing to innovate for advertisers with AI. For example, in September, we announced an agentic AI tool in Creative Studio that plans and executes the entire creative process in a matter of hours instead of weeks. We're also inventing and seeing strong momentum in several other areas, and I'll mention just a few. In Prime Video Live Sports, NBA on Prime tipped off last week, and our opening night doubleheader averaged 1.25 million viewers in the U.S., a double-digit increase over last season on cable. You'll see us bring the same constant innovation here that we brought to our NFL broadcasts. We're adding golf with the Masters in 2026 and a new skins competition with the PGA Tour on Black Friday this year. And we've added Peacock and Fox One to Prime Video's add-on subscription offering of over 100 channels in the U.S. We continue to be energized by the response to Alexa Plus. Compared to what we call the classic Alexa experience, Alexa Plus customers are talking to Alexa 2 times more. Those interactions are much longer, and they're covering a broader range of topics. They're using Alexa Plus on Fire TV at 2.5 times the rate of Classic, using natural conversation to discover audio content 4 times more, engaging with photos 4 times more, and customers are completing 4 times more shopping conversations that end in a purchase. We've expanded the number of Project Kuiper satellites in space to more than 150, and delivered over 1 gigabit per second speeds in tests with our enterprise-grade customer terminal, the first commercial phased array we know of to clear that threshold. Finally, Zoox robotaxis are available to riders in Las Vegas, and we've announced Washington, D.C. as the 8th testing location. We're excited for these to continue rolling out to more riders. Q4 is one of our busiest and most energizing times of the year, and we're excited about the continued demand for AWS, the innovations we'll announce at reInvent in December, the positive customer response to our AI-powered experiences, all the gifts we'll be delivering throughout the holiday season, and a lot more. Thanks in advance to our teammates around the world who are gearing up to deliver for customers once again. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Starting with our top-line financial results, worldwide revenue was $180.2 billion, a 12% increase year-over-year, excluding a 90 basis point favorable impact of foreign exchange. In Q3, we reported worldwide operating income of $17.4 billion. This operating income includes two special charges, which reduced operating income by $4.3 billion. The first charge of $2.5 billion is related to a legal settlement with the Federal Trade Commission, which impacts the North America segment and is recorded in the other operating expense line. The second charge of $1.8 billion relates to severance costs for role eliminations and impacts all three of our segments. The severance charge is recorded primarily in the technology and infrastructure, sales and marketing, and general and administrative expense line items. Excluding these two charges, worldwide operating income would have been $21.7 billion, or $1.2 billion above the high end of our guidance range. Moving to our segment results. We remain encouraged by the innovation our teams are delivering for customers across all three segments. In the North America segment, third quarter revenue was $106.3 billion, an increase of 11% year-over-year. International segment revenue was $40.9 billion, an increase of 10% year-over-year, excluding the impact of foreign exchange. Worldwide paid units grew 11% year-over-year. We continue to prioritize the inputs that matter most to our customers. In the third quarter, our sharp pricing, broad selection, and fast delivery speeds continue to resonate with customers. Customers appreciate the ability to quickly receive items essential for their daily needs, including perishable groceries, and have them delivered in the same day. Our millions of global third-party sellers continue to be important contributors to our vast selection, which helps customers find the items they need at competitive prices. We're committed to building innovative services and features for our sellers, including our ongoing advancements in generative AI. Today, more than 1.3 million sellers have used our generative AI capabilities to more quickly launch high-quality listings. Better listings translate into better traction with customers, and in Q3, worldwide third-party seller unit mix was 62%, up 200 basis points from Q3 of last year. Shifting to profitability, North America segment operating income was $4.8 billion, with an operating margin of 4.5%. Excluding the $2.5 billion charge related to the legal settlement with the FTC, North America segment operating income would have been $7.3 billion, with an operating margin of 6.9%. North America segment operating margin also includes a portion of the severance charge. International segment operating income was $1.2 billion, with an operating margin of 2.9%. Excluding the impact of the severance charge, international segment operating margins expanded year-over-year. Globally, our progress on key inputs is delivering a better customer experience while driving a more efficient cost structure. For example, we're making notable strides in improving inventory placement to speed up delivery to customers. And as a result, for the third year in a row, we are on track to deliver our fastest speeds ever for Prime members in 2025. We continue to tune and improve our fulfillment operations, and our regionalized network is operating at scale. We see many benefits from our inbound process improvements, including a reduction of U.S. inbound lead time by nearly 4 days compared to last year. This allows us to be more efficient with our inventory purchasing, which benefits working capital. We're also placing inventory more strategically throughout the network. And by leveraging our existing infrastructure, we're now offering U.S. customers the ability to order perishable groceries and receive them the same day in as little as 5 hours. We're seeing positive early results. Since launching in January, when customers start shopping fresh groceries on Amazon, they are visiting the site more often and returning twice as often as non-perishable shoppers. Looking ahead, we see further opportunity to improve productivity in our global fulfillment and transportation network. We will continue to improve inventory placement to drive down distance traveled and touches per package. We will also build on the gains from our regionalized network through algorithmic improvements, as well as launching robotics and automation. While operating margin may fluctuate quarter to quarter, we have a deliberate approach to achieve sustained progress over the long term. Shifting to advertising. Advertising revenue was $17.7 billion, and growth accelerated for the third consecutive quarter. We continue to see strong growth on an increasingly large base as our full funnel advertising approach of connecting brands with customers is resonating. Moving next to our AWS segment, revenue was $33 billion, up 20.2% year over year. This is an acceleration of 270 basis points compared to last quarter, driven by strong growth across both our AI and core services and more capacity which has come online to support customer demand. AWS revenue increased $2.1 billion quarter over quarter and now has an annualized revenue run rate of $132 billion. AWS operating income was $11.4 billion and reflects our continued growth coupled with our focus on driving efficiencies across the business. We are expanding our data center footprint largely to accommodate Gen AI, and to the extent those assets were placed into service, the related depreciation does impact our margins. As we've long said, we expect AWS operating margins to fluctuate over time, driven in part by the level of investments we're making at any point in time. Now turning to our cash CapEx, which was $34.2 billion in Q3. We've now spent $89.9 billion so far this year. This primarily relates to AWS as we invest to support demand for our AI and core services and in custom silicon like Trainium, as well as tech infrastructure to support our North America and international segments. We'll continue to make significant investments, especially in AI, as we believe it to be a massive opportunity with the potential for strong returns on invested capital over the long term. Additionally, we continue to invest in our fulfillment and transportation network to support the growth of the business, improve delivery speeds, and lower our cost to serve. These investments will support growth for many years to come. Looking ahead, we expect our full-year cash CapEx to be approximately $125 billion in 2025, and we expect that amount will increase in 2026. I'll finish up my remarks with net income. While we primarily focus our comments on operating income, our third quarter net income of $21.2 billion includes a pre-tax gain of $9.5 billion related to our investment in Anthropic. This investment activity is not related to Amazon's ongoing operations and is included in non-operating income. We're encouraged by the start of the peak season, and we are ready to serve customers in the coming months. I want to thank our teams across Amazon for their hard work as we get ready to delight customers during the holiday season. Our commitment to elevating the customer experience is the only reliable way to drive sustainable value for our shareholders. With that, let's move on to your questions.
Thank you. At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touch-tone telephone at this time. Please hold while we poll for questions. And our first question comes from the line of Justin Post with Bank of America. Please proceed.
Great, thank you. I'll ask on AWS. Can you just kind of go through how you're feeling about your capacity levels and how capacity constrained you are right now? And then on your prepared remarks, you mentioned Trainium 3 demand and maybe broadening out your customer base. Can you talk about the demand you're seeing, outside of your major customers for Trainium? Thank you.
Yeah, on the capacity side, we brought in quite a bit of capacity, as I mentioned in my opening comments, 3.8 gigawatts of capacity in the last year, with another gigawatt plus coming in the fourth quarter, and we expect to double our overall capacity by the end of 2027. So we're bringing in quite a bit of capacity. Today, overall in the industry, maybe the bottleneck is power. I think at some point it may move to chips, but we're bringing in quite a bit of capacity, and as fast as we're bringing it in right now, we are monetizing it. And then on the Trainium demand outside of our major customers. So first of all, as I mentioned on Trainium 2, it's really doing well. It's fully subscribed on Trainium 2. We have, it's a multi-billion-dollar business at this point. It grew 150% quarter over quarter in revenue. And you see really big projects at scale now, like our project Rainier that we're doing with Anthropic, where they're running they're training the next version of Claude on top of Trainium 2 on 500,000 Trainium 2 chips, going to 1 million Trainium 2 chips by the end of the year. As I mentioned, we have today with Trainium 2, we have a small number of very large customers on it. But because Trainium is 30 to 40% more price performant than other options out there, and because as customers, as they start to contemplate broader scale of their production workloads, moving to being AI focused and using inference, they badly care about price performance. And so we have a lot of demand for Trainium. Trainium 3 should preview at the end of this year with much fuller volumes coming in the beginning of 26. We have a lot of customers, both very large and I'll call it medium size, who are quite interested in Trainium 3.
And the next question comes from the line of Brian Nowak with Morgan Stanley.
Thanks for taking my questions. Congrats on the quarter, guys. So maybe two. One, Andy, sort of a philosophical chip question. There's a lot of questions in the market about Trainium and sort of its positioning versus other third-party chips. So how do you think about the key hurdles with Trainium 3 you need to overcome to really make Trainium adoption broader, to your point on the last question, and continue to drive Trainium, as opposed to satisfying what could be broader demand with third-party chips in the near term?
Yeah, well, first of all, we're always going to have multiple chip options for our customers. It's been true in every major technology building block or component that we've had in AWS. Really, in the history of AWS, it's never just one player that over a long period of time has the entire market segment and can satisfy everybody's needs on every dimension. And so we have a very deep relationship with NVIDIA. We have for a very long time, and we will for as long as I can foresee the future. We buy a lot of NVIDIA. We are not constrained in any way in buying NVIDIA, and I expect that we'll continue to buy more NVIDIA both next year and in the future. But we're different from most technology companies in that we have our own very strong chip team, and this is our Annapurna team. And you saw it first on the CPU side with what we built with Graviton, which is about 40% better price performance than the other x86 processors. And you're seeing it again on the custom silicon on the AI side with Trainium, which is about the same amount of price performance benefit for customers relative to other GPU options. And our customers, to be able to use AI as expansively as they want, and remember, it's still relatively early days at this point, they're going to need better price performance, and they care about it deeply. And so, I mentioned earlier the momentum that Trainium 2 has, and I think that for us, as we think about Trainium 3, I expect Trainium 3 will be about 40% better than Trainium 2, and Trainium 2 is already very advantaged on price performance. So we have to, of course, deliver the chip. We have to deliver it in volumes and deliver it quickly. And we have to, continue to work on the software ecosystem, which gets better all the time. And as we have more proof points, like we have with Project Rainier, with what Anthropic is doing on Trainium 2, it builds increasing credibility for Trainium. And I think customers are very bullish about it. And I'm bullish about it as well.
And our next question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks for taking the question. I'll stick with basically the same topic, Andy. But can you just talk a little bit about the architecture of Project Rainier and how it's differentiated, and what that means for customers and for AWS? And do you expect Rainier to expand beyond Anthropic? And how do you replicate Rainier with Trainium3 chips? Thanks.
Yeah, I think what is compelling for Anthropic around Project Rainier is, really is the Trainium2 chip, which, we've built first of all, we built a very large cluster that they can use in a very expansive way. And it's not simple to be able to build a cluster that has 500,000 plus chips going to 1 million. That's an infrastructure feat that's hard to do at scale. And so, some piece of it is the infrastructure capabilities that we've built over a long period of time in AWS that is, unusual in the industry. But it's just also the performance of the chip and the price performance, which both of which matter. And I think that Project Rainier is something that is specific for Anthropic, but we have a lot of other customers who are interested in employing large clusters of Trainium chips that we're going to hopefully give them a chance to do so with Trainium3.
And the next question comes from the line of Mark Mahaney with Evercore ISI. Please proceed with your question.
Thanks. I want to ask about two topics, groceries and then how to think about headcount in the future. And on groceries, I want to, the perishables, I think last quarter you talked about 70% or something of users had never purchased from perishables from Amazon before. Just talk about whether I think you used the term game changer before. Does this mean that maybe you no longer need to do Amazon Fresh stores? You always had this DVD delivery van density advantage. And have you kind of reached a point, you think, of scale and speed that you really can change people's habits and really have them consider Amazon as one of their first grocery options? Do you really feel like you're at that point? And then secondly, just on the headcount, given some of the recent news, just talk to us about how you think about headcount going forward. Are you seeing is the level of efficiencies that you're getting from AI such that you can keep headcount relatively flattish for the foreseeable future? Just talk about the pros and cons or the wins and losses in terms of that headcount going forward. Thank you.
Yeah, so I'll start with grocery, Mark. We have a very large grocery business. If you look at our entire grocery business, if I don't even count Whole Foods Market and Fresh, in the last 12 months, it's over $100 billion of gross merchandising sales, which would make us a top 3 grocery in the U.S. A good chunk of it is a lot of the items that you'd find in the middle aisles, so consumables and canned goods and pet food and health and beauty, very significant, that continues to grow at a very good clip. But then, we also have Whole Foods Market, which is the pioneer in organic foods, which is also growing at a faster clip than most grocery companies and with an attractive trajectory on profitability. And we'll expand our Whole Foods physical presence over the coming years here. And I'm also very excited about this new concept, Daily Shop, that we have, which is a smaller version of Whole Foods in urban settings, which we have 3 that we've launched that are off to very good starts that you should expect to see more of as well. Now, we have always been, as you referenced, we've talked a lot about having a larger mass physical presence. And we continue to experiment with various formats. But the one that we are most excited about is what you referenced, which is the ability to provide perishable groceries with same-day deliveries. And if you think about how many of our customers are buying from us multiple times a week and who are buying things like shampoo or detergent or paper cups or water, where the ability to add milk and eggs and yogurt and other perishables to their order and have it live in the same shopping cart and then show up a few hours later is very compelling. And we started with a few markets about a year ago, and we were really taken aback at the adoption, not just the number of people that started buying perishables from us very quickly, but how often they came back downstream to buy perishables and groceries from us in the future. And so we've now expanded that to 1,000 cities around the U.S. We'll be in 2,300 by the end of the year. and it's really changing the trajectory and the size of our grocery business. And I also believe that this many years tradition of the weekly stock up, grocery stock up is changing, and I think we're a big part of that. And I think there's a lot of potential there for the grocery side. It doesn't mean that we won't continue to experiment with other physical formats, but we're on to something very significant with what we're doing with perishables from our same day facilities. And then on your headcount question, what I would tell you is, the announcement that we made a few days ago was not really financially driven, and it's not even really AI driven. Not right now, at least. It's culture. And if you grow as fast as we did for several years, the size of businesses, the number of people, the number of locations, the types of businesses you're in, you end up with a lot more people than what you had before, and you end up with a lot more layers. And when that happens, sometimes without realizing it, you can weaken the ownership of the people that you have who are doing the actual work and who own most of the two-way door decisions, the ones that should be made quickly and right at the front line, and it can lead to slowing you down. And as a leadership team, we are committed to operating like the world's largest startup, and that means removing layers, it means increasing the amount of ownership that people have, and it means inventing and moving quickly. And I don't know if there's ever been a time in the history of Amazon or maybe business in general with the technology transformation happening right now, where it's important to be lean, it's important to be flat, and it's important to move fast. And that's what we're going to do.
And the next question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks so much for taking the question. Wanted to know, Andy, if you could reflect on the opportunity that's continuing to present itself in terms of rolling out more robotics and automation and the broader theme of physical AI across your operations, and how you should be thinking about that as a driver of potential efficiencies, but also as a driver of the ability to possibly reinvest back in the business over the long term. Thanks so much.
Robotics is a very substantial area of investment for us. We have over 1 million robots in our fulfillment network at this point. And I would say that while that's significant, we have a lot of invention in flight. So I expect that we'll have more over a period of time. Robotics are very important for us and for our customers and for our teammates because they improve safety, they boost productivity, they increase speed, and they let our human teammates focus on problem solving and what they do best. And we expect that our people will remain at the heart and the center of our fulfillment network, as they have from when we first started working on robotics. And we expect that over time we will have a fulfillment network where robots and humans complement each other and work together. But I think you're going to continue to see us invest very significantly in robotics. It's going to help on the safety, the productivity, the speed, and ultimately some of the cost pieces, which will allow us to continue to improve the customer experience.
And the next question comes from the line of John Blackledge with TD Cowen. Please proceed with your question.
Great. Thank you. How does Amazon think about agentic commerce going forward, and how do you think Amazon will serve customers using agents to purchase goods on Amazon in the future? Thank you.
I'm very excited about, and as a business, we're very excited about in the long term, the prospect of agentic commerce. And it has a chance to be good for customers. It has a chance to be really good for e-commerce. And, I think if you know what you want to buy, there are a few experiences that are better than coming to Amazon. But if you don't know what you want, it's, a physical store with a physical salesperson still has some advantages. Obviously, lots of people do it on Amazon all the time, but you very often want to ask questions and get help narrowing what you're going to look for. And as you keep asking new questions, having a whole bunch of different options presented to you. And I think AI and agentic commerce are going to change the experience online, where that experience where you're narrowing what you want when you don't know is going to get better online than it even is in physical environments. Now, we obviously have our own efforts here in agentic commerce. We have Rufus, which I talked about in my opening comments, which is continuing to get better and better and used more broadly. And we have features like Buy For Me, where we will surface on Amazon even items that we don't stock that other merchants have. And then if customers want us to go and buy it for them on those merchants' websites, we will do that. And both of those have been successful for us. But we're also having conversations with and expect over time to partner with third-party agents. And I think that it reminds me in some ways of the beginning of search engines many years ago being sources of discovery for commerce. And you had to kind of figure out the right way to work together. And today, search engines are a very small part of our referral traffic, and third-party agents are a very small subset of that. But I do think that we will find ways to partner. We have to find a way, though, that makes the customer experience good. Right now, I would say the customer experience is not good. There's no personalization. There's no shopping history. The delivery estimates are frequently wrong. The prices are often wrong. So we've got to find a way to make the customer experience better and have the right exchange of value. But I do think that the exciting part of this and the promise is that AI and agentic commerce solutions are going to expand the amount of shopping that happens online. And I think that's really good for customers, and I think it's really good for Amazon, because at the end of the day, you're going to buy from the outfit that allows you to have the broadest selection, great value, and continues to deliver for you very quickly and reliably. And I think that bodes well for us.
And our final question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Thanks. Good afternoon. I guess first on AWS, following up there, how much of this acceleration is driven by core infrastructure versus AI workload monetization? And I think part of it is trying to understand how important newer services like Agent Core are becoming in bringing enterprises to AWS to build agents. And then I guess secondly, regarding the acceleration in advertising, if you could potentially disaggregate the core advertising contribution versus DSP and Prime Video, that would be helpful as well. Thank you.
Yeah, I'll start on the AWS side. We are seeing, we're really pleased with the results from this quarter. 20% year over year on a annualized run rate of $132 billion is unusual. And we have momentum, you can see it. And we see the growth in, both our AI area, where we see it in inference, we see it in training, we see it in the use of our Trainium custom silicon. Bedrock continues to grow really quickly. SageMaker continues to grow quickly. And, I think that the number of companies who are working on building agents is very significant. I do believe that a lot of the value that companies will realize over time in AI will come from agents. And I think that building agents today is still harder than it should be. You need tools to make it easier, which is why we built Strands, which is an open source capability that lets people build agents from any model that they can imagine. But even more so, when you talk to enterprises or companies that care a lot about security and scale, they're starting to build agents, and they don't really feel like they've had building blocks that allow them to have the type of secure, scalable agents that they need to bet their businesses and their customer experiences and their data on. And that was really the inspiration behind Agent Core, was to build another set of primitive building blocks like we built in the early days of AWS, where it was compute and storage and database. We defined a set of building blocks that you needed to be able to deploy agents securely and scalably that we provide in Agent Core. And then when we talk to our customers, it really like it is changing their time frame and their receptivity to building agents, and it's very compelling for them. So I do think, you know, the combination of what we're doing to enable agents to be built and run securely and scalably, as well as some of the agents that we're building ourselves that our customers are excited about, are compelling for them. And, you know, I think the other place we see a lot of growth in AWS also, you know, is just the number of enterprises who've gotten back to moving from on-premises infrastructure to the cloud. And we continue to earn the lion's share of those transformations. And, you know, I look at the momentum we have right now, and I believe that we can continue to grow at a clip like this for a while. You know, I think on the advertising side, you know, that is also an area where I think collectively we feel very pleased about the progress. Every single one of our advertising offerings this quarter grew in a meaningful way. I think there's a few things going on for us. We have what I think of as a pretty unusual full funnel offering. And if you look at the top of the funnel, which typically tends to be awareness building and broad scale, to be able to use our own, you know, Prime Video and our live sports capabilities, as well as going all the way down to the bottom of the funnel at point of sale, being able to use sponsored products. That's, you know, most people don't have a full funnel offering as robust as that. And then when you layer on top of it the combination of the audience curation and development we can do, along with the advantage measurement, it just all leads to a return on advertising spend that's very unusual. And I think there are multiple places where we can expect to continue to grow. You know, one is in our stores business. I still think, you know, if you look at the worldwide market segment share of retail, still 80 to 85% of it lives in physical stores. And that equation is going to flip over time. And I think AI is going to only accelerate that. So I think we have an opportunity, a significant opportunity still in our existing stores. And then I think video, you know, we've only been at this for a little bit of time, but it's already a very large amount of advertising revenue, and we're still relatively early stage. I think that will continue to be a big area of growth. And then as you reference, the amount, their demand side platform, or Amazon DSP, that is growing really quickly as well. And some of it had to do with the fact that we had some features. We always had a number of the core components people wanted around some of our properties, the measurement capabilities, Amazon Marketing Cloud, but we lacked some features for a while as we were building out our DSP that customers told us mattered. And the team over the last 20 months have you know, closed those gaps in a very significant way, so that now people feel like our DSP is fully featured. And then you look at some of the partnerships that we've done. You know, the Roku partnership gives us the largest connected TV footprint in the US. And you layer on top of that what we've recently done in providing our DSP customers the opportunity to integrate with the ad inventory in Netflix and Spotify and Sirius XM. You know, it's powerful. And so we are growing very quickly on the demand side platform. So very optimistic about what we're doing there. We've continued work to do, obviously, but I don't think we're close to being able to grow there.
Thanks for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to speaking with you again next quarter.
Wow. What a call. What a call. We got some keynotes in there. They're going to grow capital expenditure where it is today, which is like 115.9 billion to over 125. Like, that's insane. They had the cash flow to do it. Their cash flow is growing at a pretty rapid pace. It was something I actually just took a screenshot of. No, I took a screenshot of something else. But I think right now they were, I think in the trailing 12 months at 120. Now they're at 130 billion in the trailing 12 months of ops cash, and they're about to go into their fourth quarter, which is always their best quarter. They're expecting over about 210 billion in terms of revenue for the fourth quarter. Some interesting other features in there, talking about how they're trying to optimize grocery. For those people that haven't heard, those Amazon Go stores, some of them have seen mixed review. I'm curious actually, because one of the places I'm going to next week had an Amazon Go store, and I'm curious if it's going to still be there, to see how it's competing, and see if it's been shut down or not. So I'm curious if it's been there or not. It's right next to the train station, so I'll be sure to see if it's there. But yeah, like I liked it. I went to it a couple times, and it was something I would grab, like waters in the morning, because when you're in a hotel, you don't have a water fountain or something that you can kind of use, right? It's either you're drinking from a bottle or what have you. So yeah, excited to see where that potentially goes. They also noted something, that the people that are using, the Prime members that are utilizing the grocery delivery are 2x more likely to show back up to the store. I thought that was very interesting to see, and so curious with that. Let's move the chat over to what's going on with strategy. You guys can stay or go. No harm, no foul. But strategy is obviously their call started at the same time, and there's still 3,000 people watching it. So I'm curious to see how that looked. MicroStrategy obviously not really showing up much after hours, but they're claiming a 25%, 26% Bitcoin yield for the year, and yeah, they're doing rather well. They have over 600,000 Bitcoin. I think it was close to like 650,000 or something like that, 640,000 Bitcoin. So overall price of that was in the 40 odd billion dollar range. So yeah, curious to see what they have to say, particularly around MicroStrategy. So let's give it a go. We might not listen to the whole thing, guys.
Interactive. Start with everyone. Treasurer. Hello, everyone, and good evening. I'm Shirish Jajodia, Corporate Treasurer and Head of Investor Relations at Strategy. I will be your moderator for Strategy's 2025 third quarter earnings webinar. We will start with the call with a 60 minutes presentation, starting first with Andrew Kang, followed by Phong Lee, and then Michael Saylor. This will be followed by a 30 minutes interactive Q&A session with 4 Wall Street equity analysts and 4 Bitcoin analysts. Before we proceed, I will read the safe harbor statement. Some of the information we provide in this presentation regarding our future expectations, plans, guidance, and prospects may constitute forward-looking statements, including, without limitation, our guidance with respect to earnings and our KPIs contained in this presentation. Actual results may differ materially from these forward-looking statements due to various important factors, including fluctuations in the price of Bitcoin and the risk factors discussed in our most recent quarterly report on Form 10-Q filed with the SEC on August 5th, 2025, and our current report on Form 8-K filed with the SEC on October 6, 2025. We assume no obligation to update these forward-looking statements, which speak only as of today. With that, I will turn the call over to Andrew Kang, the CFO of Strategy.
Thank you, Shirish. I'll start with some highlights for the quarter. We now hold 640,808 Bitcoin, or over 3% of all Bitcoin ever to exist. This reinforces the scale and the dominance of our corporate Bitcoin treasury company. We have a market cap of $83 billion, which positions us among top publicly listed companies in the US. And we have 4 listed preferred securities in the market: STRF, STRK, STRD, and STRC, with STRC or Stretch being the largest US IPO of 2025 so far, and all which continue to grow in liquidity and investor interest each and every day. We've also raised $19.8 billion in capital year to date to acquire more Bitcoin, and our capital markets platform continues to deepen in liquidity and investor interest, and we continue to show positive performance in our Bitcoin metrics, all central to generating long-term shareholder value. Moving on to EPS results. Turning to our Q3 2025 GAAP financial results, we reported $3.9 billion in operating income, $2.8 billion in net income, and earnings of $8.43 per share. That's a transformative improvement year over year, reflecting a strong performance in Bitcoin, the fair value treatment we now have on our Bitcoin, and disciplined capital raising activities. This marks our second consecutive quarter of significant positive GAAP earnings and over $8 billion in positive earnings in the last 4 quarters. Next slide. Our results for the first 9 months of the year show $12 billion in GAAP operating income, $8.6 billion in net income, and earnings of $27.80 per share, continuing our record-breaking year of performance. Moving on to Bitcoin per share. Bitcoin per share, as we introduced last quarter, measures the accretion of Bitcoin on a per-share basis by calculating the ratio between the company's Bitcoin holdings and assumed diluted shares outstanding, here represented in Satoshis. Through October 26th, our Bitcoin per share was 41,370, compared to Bitcoin per share of 39,716 as of July 31st. We are consistently accumulating more Bitcoin per share each quarter, the highest of any Bitcoin treasury company, creating direct and measurable value for our shareholders. Next slide. Since adopting our Bitcoin strategy in 2020, we've consistently increased Bitcoin per share. We began with 56,598 Bitcoin per share in 2020, and as of October 2025, that has grown to 200,197 Bitcoin per share, more than a 3.5 times increase over that period. We've also grown BTC yield year after year through disciplined capital raises and immediate conversion into Bitcoin on our balance sheet, reflecting a 26% BTC yield year to date. This sustained growth reinforces our ability to deliver Bitcoin yield to our shareholders through market cycles and by continuously executing on our capital markets and acquisition strategy. Next slide. Here, we highlight our year-to-date Bitcoin performance metrics versus our full year 2025 targets. Year to date, we've achieved a 26% BTC yield compared to our revised full year target of 30%. Our year-to-date BTC gain is 116,555 BTC, up from 88,000 at the end of Q2, reflecting disciplined capital deployment and the strengthening of our Bitcoin balance sheet. Our BTC gain performance translates into approximately $12.9 billion in BTC dollar gain year to date, compared to our $20 billion full year goal. Next slide. We now hold 640,808 Bitcoin, or $71 billion, purchased at a total cost of $47 billion, or an average $74,000 per Bitcoin. And we now hold approximately 3.1% of all Bitcoin that will ever exist. And as in the past, 100% of our Bitcoin remain fully unencumbered. This next slide highlights the transformation of our balance sheet over the past year and the continued strength we've seen through the third quarter. Year over year, digital assets grew from just under $7 billion in Q3 of 2024 to just over $73 billion, in Q3 of 2025, driven by both additional Bitcoin acquisitions and the adoption of fair value accounting at the beginning of the year. The accounting change alone added approximately $18 billion to our digital assets and $12.7 billion to total equity at the time of adoption. Quarter over quarter, digital assets have continued to climb from $64.4 billion in Q2 to $73.2 billion in Q3, alongside steady growth in total equity on our balance sheet, reaching now $58.1 billion at the end of Q3. Overall, fair value accounting has made our balance sheet more transparent for our investors, while execution in introducing innovative digital credit through our preferred equity IPOs this year has continued to expand shareholder equity and reinforce the company's position as the leading Bitcoin treasury company. Next slide. In Q3, we recognized an increase in our Bitcoin holdings from $64.4 billion at the end of Q2 to $73.2 billion at the end of Q3. This increase was made up of $3.9 billion of fair value gain in our Bitcoin holdings, which is due to the change in Bitcoin price between the first and last day of the quarter, and also through the addition of $5 billion of new Bitcoin added to our balance sheet in Q3. Next slide. As of October 24th, our enterprise value was $98 billion with a market cap of $83 billion, which was supported by a Bitcoin net asset value of $71 billion or 72% of total enterprise value. Our $8.2 billion of convertible debt is equal to just 11.6% of our total Bitcoin NAV, and the $6.6 billion of prefs represent just 9.3% of our Bitcoin holdings. Our annual dividend and interest obligations total $689 million, which is less than 1% of our total Bitcoin, reflecting the efficiency and sustainability of our balance sheet. And our capital structure is built to endure volatility, provide stability, scalability, and long-term shareholder confidence. Next slide. We continue to have $8.2 billion in total notional debt across our converts, with all but two that remain in the money, with a total weighted average maturity of 4.4 years. The total current notional value of our outstanding preferred equity as of October 24th stands at approximately $6.7 billion, up from $6.3 billion as of July 29th. Next slide. Our total annual interest and dividend obligations are $689 million, which consists of $35 million in interest expense on our converts, which is about 42 basis points average cost. And we have $522 million in dividend obligations from our cumulative preferreds, STRF, STRC, and STRK, and an additional $125 million related to our non-cumulative preferred STRD. Here we show we have more than sufficient access to liquidity to manage our total annual interest and dividend obligations through our proven track record of capital raising activities. Our total annual obligations represent only about 1.7% of total capital raised in the last 12 months, and only about 2.6% of total common equity raised in the last 12 months. As a measure of our strong financial performance, our fixed obligations represent only 6.1% of year-to-date GAAP operating income. Next slide. Finally, we are extremely pleased with the IRS interim guidance that was issued on September 30th, which now excludes unrealized gains from our Bitcoin holdings from adjusted financial statement income for purposes of CAMT. Not only does this important clarification directly benefit Strategy, but it also paves the way for other corporations to hold and grow Bitcoin on their balance sheets. We are grateful and appreciative for the support of Treasury, IRS, Congress, and the administration for aligning on the importance of clarifying this specific rule under CAMT and lifting what otherwise would have been an extremely burdensome rule that would have targeted digital assets and for continuing to support the growth and innovation of the digital asset economy. I'll now turn the call over to Phong Le, Strategy's President and CEO. Thank you.
Thank you, Andrew. I will go through an update on our capital markets activity, and then I will review the guidance that we provided for 2025. So first, I want to welcome and invite everybody to join us in 4 months in Las Vegas at the beautiful Wynn Resort for Strategy World 2026 and our 5th annual Bitcoin for Corporations. So hopefully those who are listening or watching this presentation and have been a fan of Strategy software or Strategy and our Bitcoin strategy can come out and join us. So next slide, Trish. So taking a step back, we used to compare ourselves to other companies that held Bitcoin on their balance sheet. And as you know, with over 640,000 Bitcoin and nearly over 3.1% or nearly 3.1% of all the Bitcoin ever to be created in the world, we found it best to compare ourselves to the largest corporate treasuries in the world. You'll see here with $71 billion of Bitcoin on our balance sheet, we're 5th when comparing cash and short-term investments and excluding financial services companies. And our aspiration the next year is to be number 2 and the next 5 to 10 years to be number 1. And so how do we do that? Next slide. What we've done in the past, in the last 2 years, is raise a significant amount of equity and capital through the capital markets. In 2024, we raised $22.6 million, and about 27% of that, or $6.2 million, was from the convertible debt market. Year to date this year, we've raised $19.8 billion. And what you can see here is the way we've raised it has changed significantly. We've reduced our convertible debt raises to about 10%, and we've increased our raises through preferreds to $6 billion, or about 30%. And that has all happened this year. It's really just been since the end of January of 2025 that we've launched our preferred strategy, and it's been very successful so far, year to date. As we start to reduce our reliance on convertible notes, our plan is to allow those to equitize over time. And based on the earliest potential equitization dates, you'll see here that by 2029, we'll have no more convertible debt on our balance sheet. And instead, what we'll do is we'll start to season the preferred market. You'll see through the course of this year, through 4 IPOs, and as Andrew mentioned, the largest IPO coming 3 months ago with STRC or Stretch, we've been able to raise $6.7 billion through the preferred market. And interestingly, as you look at this, a large portion of that raise has come from the retail market. The initial offering Strike had about 4% access or raises through retail, and the latest one, Stretch, had about 23% through retail. Next slide, Trish. So how do we season the market and how do we grow our preferred offerings and raising more capital through our preferred offerings? 3 real techniques that you'll see us continue to use. First is distribution. Recently, in the last month, we've seen more brokerages list our preferreds. Robinhood listed each of our 4 preferreds in the last month, and we've seen significant volume and liquidity through Robinhood. And they listed those as the first ever preferreds on the platform because of demand from other folks that were on Robinhood. We're also going to continue to distribute through wealth management, broker-dealers, RIAs. Morgan Stanley participated in our latest preferred, which gave us significant access to their wealth management channel, retail customers. And we'll start to work with different banks and financial institutions to explore other types of products, potentially ETF wrappers and structured finance products that have our preferreds underlying them. We're doing more and more in terms of field marketing, industry conferences, leverage finance events where we seek access to customers and buyers who are interested in credit and debt products. We're also doing more and more teach-ins, so just feet on the street, meeting with financial advisors, brokers, RIAs, and family offices. And last is you'll see more digital marketing. Right, you're already seeing us provide some information and advertise some of our preferreds, namely Stretch and social media and X. We plan to have even greater presence on YouTube, traditional media potentially, channels like Wall Street Journal and Bloomberg. We continue to use our strategy.com website and our strategy app, which if you have not downloaded it, I suggest you do so, and more presence on interviews and podcasts. So these are 3 different ways we'll continue to create distribution and awareness of our credit instruments. The other area of distribution that we are going to look to access with our preferred credit instruments is international expansion. Right. Currently, our products are listed on the NASDAQ and are US-based products, US dollar-based products. But there's a significant access to capital that we can get if we were to, as an example, launch a Canadian product on a Canadian exchange in Canadian dollars, launch a European product on a European exchange, a euro, or potentially other areas of the world like Asia or Latin America also. And we think by accessing these markets and by providing new products that are similar to our preferred products like Stretch or Strife, that we can access even greater pools of capital to provide more funding for us to ultimately buy more Bitcoin that's accretive to our shareholders. We announced this week on Monday that we have now the first ever published rating of a Bitcoin treasury company by a major credit agency. S&P assigned us a B- issuer credit rating to Strategy. And we think this is a big milestone, not just for Strategy and for Bitcoin treasury companies, but a big milestone for Bitcoin in and of itself. There's been a lot of discussion around whether we think this is a good rating or not a good rating. I think it's a solid starting rating. And I think even more importantly, to have a rating, it gives us access to more pools of capital. So what does a B- rating mean? By definition, it means that there's a stable outlook and it reflects the expectation that we'll continue to manage our capital structure prudently and that we maintain market access. We were rated under a structure that's a framework that's called non-bank financial institutions. That's a framework that the S&P uses to rate us. And importantly, at this point in time, Bitcoin is we don't get any credit for the Bitcoin on our balance sheet when it comes to our rating. It's deducted from our equity, and this drives negative risk-adjusted capital. So what needs to change for the rating to improve? Well, one, I think it's appropriate at some point in time that Bitcoin be treated differently and as a capital asset at full credit, and that would require the risk-adjusted capital or the Basel frameworks to change, or for S&P to change how they look at capital and at Bitcoin as capital. And I think that'll start to happen over time. We see already other banks seeing Bitcoin as potential collateral. We've seen U.S. housing agencies suggest that Bitcoin should be collateral for mortgages. So as that starts to evolve, I think the risk-adjusted capital and the Basel frameworks will start to evolve, and I think the S&P will evolve in its view on Bitcoin. But it's good to have a stake in the ground. I mentioned the potential equitization of our outstanding convertible debt because these are senior to our preferreds and are at the top of our capital structure in terms of seniority. As these start to roll off, that will start to reduce our maturity risk, and that should also improve our rating. And finally, what we've been doing for the last 5 years, we've demonstrated strong access to capital markets. We demonstrated in 2022 the ability to service our debt during a Bitcoin bear market. As we continue to show, improve, consistent leadership in this area, we'll start to see a better rating too. But I'll go to the next slide, and this is probably the most important point about getting a rating. Because we are now S&P rated, it gives us access to larger pools of capital than we had before. Right? And the unrated credit market is about $2.8 trillion worldwide. Now we have access to what we would call a high yield rated, right? A B- is in the high yield category, which is a market that's about 3 times the size of the existing market that we're in. And over time, our hope is if Bitcoin was to be treated as true capital on our balance sheet, that we would be considered an investment grade rated company. And when we get to that point, we would be able to access a market that's 11x what it is today. So in summary on the S&P rating, I think it's a good starting point, and it's important that we're rated. And I think an agency like a credit agency like S&P validates our company, starts to validate Bitcoin as an asset class, and it's a good starting point for us. The other part of S&P, so their index business has also started to embrace crypto. Right, the S&P 500 has, in successive quarters, added Coinbase, then Block, then Robinhood to their index. And we now meet all of the criteria that's required to be in the S&P 500 index. We're number 131 by market cap of U.S. publicly traded companies. And unlike the NASDAQ 100 that sets its criteria purely by market cap, S&P also has some other criteria. You have to be a U.S. company, U.S. listed, which we are. And you have to have a minimum of $23 billion market cap, which we have, and 250,000 shares traded each month for 6 months, which we have. And you have to have a last quarter with positive earnings. We've had 2 now. And some of the last 4 quarters have to have positive earnings, which we also have. So now that we meet all the criteria, the question we get often is, why are we not included? We don't know exactly, right? This is a S&P 500 process that they don't publish exactly, why someone gets added or not. But first of all, we just became eligible in the last quarter. And eligibility doesn't mean immediate inclusion. And that's pretty typical. Many other highly successful companies, Tesla and the ones I mentioned here, Block and Robinhood, were not included in their first quarter of eligibility. But we hope to access the index and $13 trillion of capital that's tracks the S&P 500 at some point in time. The other big development that's happened really just in the last 3 months with the passage of the Genius Act and with more and more government clarity on regulations related to Bitcoin and related digital assets is big banks further embracing crypto. Morgan Stanley's dropped their restrictions on which wealth clients can now own crypto funds. In fact, they can solicit Bitcoin-backed securities and including Bitcoin-backed ETFs. And they are recommending as much as in some cases 5 to 6% of clients' portfolios owning Bitcoin. They also underwrote our most recent offering, Stretch, and as I mentioned earlier, gave us access to the wealth management channel. Citibank recently launched coverage, the first I'll call it bulge bracket bank that's launched coverage on our equity, and they also provide now a price target. And they've announced that they're going to launch crypto custody services next year, which I think is going to be transformative in terms of major banks now custodying Bitcoin and other digital assets. Société Générale, which is a large bank in France, became the first major bank to launch dollar-pegged stable coins. And even banks like JP Morgan now are allowing Bitcoin and Ether as collateral with their banks. And I mentioned that Citi has launched coverage on strategy, and they've also given a Bitcoin price target, which is a major improvement. And you'll see here of all the banks that are covering us and all the research analysts that are covering us, there's an average price of Bitcoin for 2025 of $156K, average price at the end of 2026 of $180,000. You'll also see here strong price targets and ratings on all of the banks that are covering strategy. So let me move to 2025 guidance and review the guidance that we provided last quarter and talk through some of the additional guidance that we'll provide this quarter. The first piece is I want to reaffirm the BTC guidance for 2025. This is all assuming a Bitcoin price of $150,000 at year end, which is based off of the consensus targets that I just reviewed. We have a BTC yield target at the end of the year of 30% and a BTC dollar gain target of $20 billion. And we have activities underway to try to achieve those, which include capital raises and such. As for our earnings guidance, I also want to reaffirm what we communicated 3 months ago, which is an operating income target of $34 billion, a net income target of $24 billion, and an EPS target of $80 at the end of this year. Again, all assuming a Bitcoin price of $150,000. Stretch, which we just launched 3 months ago, I also want to reaffirm the guidance that we've given on how we think about the dividend rate. If the 5-day VWAP of the price of Stretch is above $101, we'd recommend a rate decrease or potentially a follow-on offering. If the 5-day VWAP is between $95 and $99, we'd recommend a 25 basis point rate increase to get the price, to try to get the price of Stretch within our target price range of $99 to $101. And if the 5-day VWAP is below $95 at the end of the month, we would recommend a 50 basis point rate increase. And so let me show you what we've done so far since we've launched Stretch and what we will update today as far as our dividend for the next month. So as you recall, when we launched the product in July, we launched with a 9% dividend rate. We increased that to 10% in August. We increased it further to 10.25% in September. And today we're announcing that effective November 1st, we'll increase another 25 basis points our dividend, and will be at 10.5% on November 1st, paid monthly. The last guidance I want to talk through is something that's new to this group, which is what we're calling return of capital guidance. And Mike will talk about this a little bit more, but this is a pretty unique feature to all of our preferred equity, which is that the dividends are paid, the dividends that are paid are taxed as a return of capital. And if it's taxed as a return of capital, it means that it's tax deferred until you sell the underlying asset. And so if you hold on to the underlying asset, you can expect that you're paying essentially zero taxes on that. That compares to a qualified dividend, which is at a rate of anywhere between 20 and 35%, depending on the state you live in and the city that you live in the US, and compare it to an interest income, which is what you would pay on something like a money market or a bank account at 37% to 55%. We call these rock dividends. It's a pretty unique feature and one that I think is not as clear and it's maybe lost on folks. But when you invest in our preferreds for the foreseeable future, you can expect rock dividends. And so why do we have rock dividends? It's fairly unique to our company, which is that we have negative taxable earnings and profits, which is a function of the business that we're in. And it's a function of our intent to buy and hold Bitcoin and not sell Bitcoin, where it's negative from a tax perspective, and not engage in activities that will result in significantly positive taxable earnings and profits. And our guidance here is that we expect that this rock treatment continues for the foreseeable future for 10 years or more. And we can impact that guidance and we can impact our negative E&P with how we run our business. So the summary here is that our preferred dividends are tax-free or tax-deferred, and that we expect that to continue for the foreseeable future. Could be 10 years, could be more than that. So with that, I want to hand it over to our Executive Chairman, Michael Saylor.
Thank you, Phong, and thanks for joining us today. I'm really excited to talk to you about digital capital and digital credit. So let's go to the first slide. The first point that I want to make is that Bitcoin has emerged as digital capital. What is digital capital? Digital gold. Capital is a long-term store of value. Bitcoin is a store of value. The US government has embraced Bitcoin as a store of value, and that means every major cabinet member, and I'm showing them here. And of course, the decision that America is going to be the Bitcoin superpower is an endorsement, along with the president's point that you don't ever sell your Bitcoin. Let's go to the next slide. Wall Street has embraced Bitcoin as digital capital. Now you've got 1.5 million Bitcoin held by the spot ETFs, about $170 billion worth. The most successful ETF in the history of Wall Street is IBIT, and IBIT has explosively grown even in the past few months. The daily liquidity in IBIT is now approaching $4 billion or more a day. Open interest in IBIT has gone to more than $50 billion in open interest. And so this is wildly successful. Next. Public companies have embraced Bitcoin as digital capital. We were the first public holder of Bitcoin. Then there were 2, then there were 4. About a year ago, there were 60. Now there are 200 plus publicly listed companies holding Bitcoin. That's more than 1 million Bitcoin, and it's about 116 billion in value. I've got a few metrics here on this slide that show just the scale of the Bitcoin market. It's a $2.3 trillion market cap. It's $58 billion of daily liquidity, $76 billion in BTC open interest in the derivatives market, and it's backed by 26 gigawatts of power. That's 26 full-on nuclear reactors. And the hash rate keeps going up. We're now up to 1100 exahash. And you have 30% of all voters in the United States that are registered, of the registered voters that are crypto holders. The industry crypto is 3.9 trillion, and there's 700 million crypto users, and of course 300 million Bitcoin holders. So this is a global movement at this point. Bitcoin is the capital asset at the center of the entire crypto industry. And it is traded on 1,000 exchanges. Next. Now, what do you do with digital gold? Well, what do you do with gold? You issue credit on gold. For 300 years, the Western world ran on gold-backed credit. Bitcoin is digital gold. What we've realized is that the killer application of digital capital is digital credit. And Strategy enables a wide variety of securities based on that digital capital. What you can see here is that the baseline is IBIT. IBIT is digital capital in an ETF wrapper, and it's got a 53% annual, 53% return on average for the past 5 years. And the volatility is 38% right now. Now, what we have done is created 4 digital credit instruments that strip the volatility and extract or distill the performance out of IBIT. So Strike's volatility is 28, and it gives you a 9% effective yield and some upside. Stride's volatility is 16. It gives you a 13% effective yield. Strife's volatility is 14, and we extracted a 9% effective yield. And of course, what we're doing is we're extracting a certain type of risk, or we're mitigating, stripping off a bunch of risk. We're extracting a yield. We're damping the volatility. And the largest piece, or the greatest piece of financial engineering we've performed is Stretch, which has converted that 38% volatility into 8 and extracted that effective yield of 10%. And of course, as you can see, since we damped the volatility, there is sort of a conservation of energy or a conservation of volatility in the thermodynamic universe. And so where does the volatility go? It goes to the equity. So the volatility that we strip off of BTC accrues to MSTR. And of course, the performance and the opportunity that we strip off of BTC also accrues to MSTR. So what you see here is a fairly straightforward financial engineering exercise. We are a structured finance company, and we are starting with a blob of high energy capital, long duration, highly volatile, high performance. We are engineering out different durations, different volatilities, different risk profiles, different performance profiles. We're even transforming it from the BTC currency into the USD or to different currencies. And that is the exercise. Next. Now, this chart shows the economic landscape we work in. Here you see Bitcoin's performance of 53% over 5 years, almost double the Mag 7. You can see gold performed 15% a year. It's slightly edged out the S&P at 14%. S&P is the conventional cost of capital. Real estate is underperforming the S&P dramatically in this time frame, only up 6% a year. Money market instruments, those short duration treasuries in the US, on average have provided 3% performance a year. And mid-dated to long-dated bonds are -3. Strategy's equity is +83. And of course, all of our financial engineering is based upon taking advantage of a lower cost of equity and a lower cost of credit, and then using that in order to acquire Bitcoin, which then accrues to the benefit of the equity holders. Let's go to the next slide. So let's look at our products. Strike. Strike is structured Bitcoin. It's convertible preferred, so it has some upside via the equity component. 33% of Strike is equity. It has some dividend, an 8% dividend at par, right now an effective yield of 9.1%. And then Strike pays ROC dividends, which means they're tax deferred as you step down your basis. And so the tax equivalent adjusted yield is 21.6%. How do you get to that? Well, you take the cost of Strike, you subtract the equity component, and then you look at the effective yield of the remainder, and then you look at the tax-adjusted effective yield, and you end up getting to 21.6%. So this is a misunderstood security, but it's got very compelling offers, because on one hand, it's an indefinite, a perpetual duration call option on the stock. And it's also a perpetual dividend. So if you're a very long-term investor that wants the best of both worlds, some upside, some income, and if you want risk stripped away, well, we've got a BTC rating of 5.2, which means that Bitcoin could fall by 80% and you would still be over collateralized. You know, if you bought Bitcoin and it fell by 80%, you lose 80% of your money. If you buy this and Bitcoin falls by 80%, you still keep your money, right? It's a principal protection. And so down here at the bottom, I've got a table, and you can see, you know, the effective yield of the things that Strike competes against are 1 to 4%. And so this is a very unique thing. And it's really it's higher yield, more upside, longer duration than alternative investments. And let's go to the next slide. Stride is our second credit instrument. This is long duration, high yield credit. The effective yield is 12.5%. That makes the tax equivalent yield nearly 20%, 19.9%. It's still 4.8 times over collateralized, so Bitcoin can still fall by 75%. You're still over collateralized. And it's got a duration of 8 years, which is a Macaulay duration. But really what you're getting is you're getting the 10% dividend at par perpetually, forever. And so if you compare it to the universe it competes against, the effective yield on most high yield corporate bonds is 6%, and they're taxable. 6.2%. Leverage loans are 6.8%. They're taxable as normal income. You know, preferred stock ETF 6.2%, emerging market debt 5.6%. So the effective yield of Stride is double, but the tax equivalent yield of Stride is triple. And so you get triple tax equivalent yield with more collateral coverage. This again is a misunderstood instrument, but if you're seeking maximum cash flows, right? And if you trust Bitcoin minimally and you trust the company, then this is a very interesting opportunity for you. The next instrument is Strife, STRF. Well, that's long duration senior credit. It's cumulative and it's got more protections because there are penalties if the company were ever to suspend a dividend, and it's also more highly collateralized. The BTC rating is 7.5. So $7.50 of Bitcoin for every dollar of Strife outstanding. The effective yield is 9.1% because it trades above par. And the tax equivalent yield is 14.4%. So when you look at this against comparable assets, the effective yield is double, the tax equivalent yield is triple, and the collateral coverage is 2 to 3x more. This has got a duration of 11 years, and so longer duration. What that means is that if interest rates move up or move down, there's going to be more volatility on this. If you believe interest rates are going to dive, then this is a great thing. You would like a long duration instrument. If you believe that interest rates are going to go up, then that would be the opposite. You probably wouldn't. Now let's go on to Stretch. Stretch is the highest degree of financial engineering we've engaged in. Because with Stretch, our goal was to strip the volatility, compress the duration, convert the BTC into a pure USD yield, and then offer that to the investor. So right now, Stretch is 10.4% effective yield, but that's a tax equivalent yield of 16%. It's just slightly under 6 times over collateralized, and of course, it's the lowest volatility. Our goal with Stretch is, we want to give everybody something that's comparable, something that's competitive with a money market that pays you 10.4% that is tax deferred. If you walk down the street and you say to someone, do you want a convertible bond? Not sure. Do you want a 20-year crypto bond? Not sure. Do you want a crypto junk bond? Not sure. Would you like a bank account that pays you 10% tax deferred? Yeah. Yeah, everybody wants a bank account that pays them 10% tax deferred, right? Why wouldn't you, right? And so this is, to be clear, it's not a bank account. It's not even a money market, but we are structuring it to compete with that source of funds. That's what we call it treasury credit. It's for corporate treasurers. It's for your family treasury. It's the money that you probably need to spend in the next 12, 24, 36 months. If you didn't need the money for 4 years or more, I would say, you probably ought to go look at buying Bitcoin. If you don't need the money for a decade, you buy Bitcoin. It's a better deal. But if you need the money in 4 months or 8 months or 2 years, or you have 30% of your working capital that's stable, that's a treasury obligation. And right now, your options aren't great. So here we're offering 10.4% effective yield, but 16% tax equivalent yield. If you look at bank accounts, they yield nothing. Money markets are 4% in the US. So this is 4 times better, 4x better than the tax equivalent yield of a money market. Now you'll note it's more volatile, right? The money markets managed to get down to less than 1% or about approximately 1% volatility. We're still 8% volatility, and I think that's in some part because we're still seasoning, and so we are going to continue to work to get this volatility down below 8 to 7 to 6. We got to 5%, about a week ago. We don't know how low we can get it, but our goal is to make it the least volatile of our credit instruments. Let's go to the next slide. Phong spoke about return of capital. The point that I want to make is, ROC dividends have been around. This is settled tax law since 1910. Return of capital has been around since 1910. You'll find hundreds of companies that have issued dividends that are return of capital. You'll find oil pipelines, natural gas companies, real estate companies, etc. We just happen to have a very compelling business model. The treasury business model allows us to have much greater visibility to return of capital than if you were just a REIT or you were a gas pipeline or something. And so the difference really is 0% upfront dividend tax rate versus 20 to 30 or 30 to 55. And, you know, if you got your money in a money market and you live in California or New York City, it's a pretty heavy tax load. And so presumably New Yorkers or San Francisco dwellers, when they start to look at this, are going to find it to be pretty compelling. The fact that we expect this to continue for the next 10 years means that we're not just announcing that this quarter is a return of capital. We're expecting the next 40 quarters to be return of capital, and I think that's a pretty material thing. Let's go to the next slide. Now, all of those credit instruments have one impact. They amplify our Bitcoin exposure. So right now, Strategy has 11% leverage, 21% amplification. Okay, amplification is the leverage that comes from debt plus the improved performance that comes from equity. Our goal, our target as a company is to drive leverage to 0. When we equitize the convertible bonds, and if we don't issue any more bonds, and we don't intend to, leverage will go from 11% to 9% to 7 to 5 to 3 to 1 to 0. So our leverage is going to 0. Our target for amplification is to drive the amplification to 30%. So we're going to drive amplification up and drive leverage down. And of course, here you can see on this chart, if we run at a 30% amplification level, you know, what naturally happens is your 200,000 Satoshis per share become 560,000 Satoshis per share over 10 years. That's a BTC factor of 2.8. That means that we actually perform 2.8 times better than an ETF. That is the source of the premium in the equity. That is the value that's being created by the digital treasury model. And of course, the value creation is a function of the amplification. When you increase leverage, you increase risk. But when you increase amplification, you just increase value creation. So if we get to 30% amplification, then we may very well go to 35 or 40% amplification because we're doing it with digital credit, and digital credit doesn't have the risk profile of debt. Let's go to the next slide. We are at a historic point. We're kind of at an inflection point, we believe. Our multiple to NAV, MNAV, has been trending down and has been trending down over time as the Bitcoin asset class matures, as the volatility decreases. The volatility, by the way, is decreasing in part because of the growth of companies like ours, the maturation of the Bitcoin treasury industry. It's decreasing because of the success of IBIT. It's decreasing because the derivatives market onshore has grown dramatically. The derivatives market in IBIT has gone from 10 billion to 50 billion. And so people are using those derivatives to damp volatility, and that's very good for the asset class. It's very good for the industry. In the near term, it's resulted probably in some pressure on our MNAV, but we think that over time, as the credit investors start to understand the appeal of digital credit, they're going to want to buy more, and we're going to sell more and issue more credit. And as the equity investors start to appreciate the uniqueness of the Bitcoin treasury model, and especially the uniqueness of our company and our ability to issue digital credit worldwide at scale, we think that that's going to drive an appreciation of the equity. Next slide. Why am I so enthusiastic about digital credit? Well, there are 7 innovations in digital credit that make it better than traditional credit. So I'm going to take you through the 7 things. First of all, traditional credit, like a mortgage, well, it's built on a depreciating house or a depreciating warehouse. Or traditional credit It's built on collateral that's a depreciating asset, a bunch of fiat currency, a corporate product, a corporate service, a corporate warehouse, a bunch of hardware, a data center full of NVIDIA chips that are depreciating with 4-year useful life. That is collateral, which is collapsing. It makes it hard to pay a higher yield when you have depreciating asset. But our collateral is Bitcoin, is digital capital, and Bitcoin is an appreciating asset. So whereas $10 billion of warehouses are most valuable the day they're built, $10 billion of Bitcoin is only going to get more valuable, not less valuable. And so that digital capital is the first big innovation. Next, the second innovation is we're replacing traditional risk with digital risk. Traditional risk, it's opaque, it's heterogeneous, it's discrete. You own 8,700 houses, or you own, you're exposed to a portfolio of 47 junk bond issuers. And maybe they're fine, but then there's a tariff, or there's a trade war, or there's a competitive change. Or maybe there's a strike, or maybe an airplane crashes, or there's a COVID lockdown. Whenever you have these kind of conventional real world issues, you have a discrete explosion of risk, a forest fire, an earthquake, or a change in a political regime, or a change in tax rates, or a change in customs duties. So traditional risk is opaque, it's heterogeneous, it's discrete. On the other hand, digital risk is transparent, it's homogeneous, it's continuous. You can go to our website and we update the risk model every 15 seconds. And so it is completely continuous. We update the price of Bitcoin. We update the volatility of Bitcoin on a continuous basis. We update the BTC ratings. You can plug in your statistical models into them. And of course, all the risk is based upon your outlook of BTC ARR, BTC vol, BTC price, and BTC rating. So digital risk is something where you don't have to wait for a year for a credit rating agency to publish a new report to tell you whether your favorite airline or your favorite, restaurant chain is riskier or less risky. With digital risk, you can literally plug into the website and you can recalibrate and calculate your risk every 15 seconds on Saturday morning. And that's a big upgrade. Now, there's a third innovation in digital credit. Our third innovation is all credit is not created equal. We don't just issue debt. Debt is credit. Bank deposits are credit. When a bank takes your money, they're creating credit, and your bank account pays you whatever they pay you. When you put money in a money market, it's credit. Of course, junk bonds, sovereign debt, mortgage-backed bonds, they're credit, but they're debt. And debt and deposits are liabilities. They amplify risk. If there's a run on the bank, people withdraw their deposits, right? You're going to have a collapse of the entire banking system.
Right.
When the debt comes due, when your 3-year note comes due, when you get to month 34, everybody goes crazy and loses their mind because the capital is getting called away from you, right? If you have a bad quarter in the 12th quarter and you've got 4-year debt, you amplify risk. The equity collapses, people go crazy.
That makes sense.
What we've done is use preferred equity. It's not debt. Sometimes people think, okay, well, it's a liability. It's equity. It's actually counted as preferred equity is equity on the balance sheet. It's not debt. It's an asset, not a liability. And so therefore, it mitigates risk. How does it mitigate risk? Well, I mean, the first obvious way it mitigates risk is when you sell $1 billion of bonds, you have to pay them back in 5 years or 7 years or 3 years. When you sell $1 billion of preferred stock, you never pay it back. So there's $1 billion of refinance risk that just goes away. The second way that it mitigates risk is that the dividends are approved by the board. They're not coupons. You miss $1 million of coupon payments, you're in default. Whereas if you're short $1 million, of a dividend payment, you can suspend $1 million. You're not in default. So you could think about preferred equity is permanent capital and shock absorbers to the business model of the company. And therefore, digital credit based on preferred equity is dramatically better than digital credit or credit that's based upon debt.
Mike, you're onto something. You're onto something, Mike.
The fourth innovation is, we didn't just issue preferred equity. We issued perpetual preferred equity. Sometimes banks or issuers issue equity which has got a 3-year life or a 5-year life or a refinance option or a call option or a put option. That creates some sort of refinance risk or withdrawal risk. But when you have a perpetual equity, it is permanent capital, right? Your bank might have $100 billion that's overnight money. Someone can take the $100 billion away from them. You have $100 billion of debt at your airline. It's going to be taken away from you in 3 to 5 years. When we have $100 billion of preferred equity, we have it forever, like forever, 1,000 years. It just goes on and on and on. Perpetual life. When you have permanent capital, you can make indefinite investments. We can buy Bitcoin to hold for 100 years if we have capital for 100 years. When you have a 5-year junk bond, you can't make a decision that's going to, and the truth is you have to have decisions that are no longer than like 2 or 3 years because you have to keep rolling them because of the refinance and the withdrawal risk. So the perpetual life of the instruments is the fourth big innovation. The fifth big innovation is that we took these securities public. This is public credit. A lot of times people sell their credit instruments via 144A offerings to a private market. It's like I sold it to 50 investors and they're traded over the counter. Those are illiquid. They're unbranded. Can anybody name the 17th tranche of bank credit sold by, one of the large banks in the US? They have CUSIP numbers. They're traded on Bloomberg's between 37 counterparties, and they all know each other. So it's unbranded, it's illiquid, it's local, it's very difficult to buy it. Even if you wanted to buy it, you would need a professional money manager to even find it for you or buy it for you. When you do, there would be 300 basis point credits or bid-ask spreads, very big spreads. The thing traded last 2 weeks ago. That's the problem with private credit. Public credit, like STRC, it's liquid. I mean, it traded nearly $100 million today in the market. It's branded. It's got a name, Stretch. It's global. You can buy it if you're in the UK from your retirement account. It's easy to access. You can buy it on Robinhood. You can buy it on Schwab. And so public securities become public brands. And if you're going to buy a credit instrument, what would you rather have? A credit instrument that's traded by 12 funds in Italy that know each other? Or would you rather have a credit instrument that's held by tens or hundreds of thousands of investors worldwide that all refer to it by the name Stretch? And if it ever gets mispriced or it gets undervalued, they're going to leap in and they're going to put lots of money behind it. When we did the IPO of Stretch, we priced it at 90. We said we're targeting par 100. There were individual investors that bought $250 million of that instrument. $250 million, right? The value of a public security, a public credit instrument, is if someone goes wacky crazy and decides they want to misprice it, there are people that will walk in and they'll buy 50 million or 100 million or 500 million to fix the market because they can. That does not happen in private credit markets. And so public branded global securities are just better. Let's go to the next innovation. Digital creation. Ask yourself, how long does it take for a bank to create $1 billion worth of home mortgages? How long does it take to issue 1,000 $1 million loans? It's very difficult. It's slow, it's expensive, it's labor intensive. So the creation of traditional credit is very hard. The reason that you have banks with 37-floor buildings that have 27,000 people in them is because the creation of credit is expensive and difficult. On the other hand, we can create $1 million of credit, $10 million of credit, $100 million of credit, or $1 billion of credit in 60 seconds on any given trading day. It's all automated, it's efficient, it's instant. So digital creation makes this completely scalable, right? We have a very scalable business model, and you can understand why if someone wanted to buy $10 billion of commercial credit backed by airplanes, it's kind of hard to create the airplanes to back the $10 billion. You can't just create the airplanes in 60 seconds. But we can buy $10 billion of Bitcoin to back $10 billion of digital credit, and we can do it contemporaneous with the demand. So that's the sixth advantage of digital credit. Let's go to the last point. The last point is traditional credit is taxable, whether it's fully taxable as a debt instrument or it's partially taxable as a qualified dividend. Digital credit is tax-deferred income, right? We pay ROC dividends. We pay ROC dividends because of the business model, because we have digital capital as the underlying asset, because we have a digital treasury company and a digital treasury company business model. We pay ROC dividends, and ROC dividends are a profound competitive advantage for the credit issuer and for the credit investor. Let's go on. Next slide. Here you can see the value of the Bitcoin treasury model. We have created a flywheel. It's a scalable, tax-efficient, fixed income generator. You issue digital equity and digital credit that's tax-deferred. We pay dividends on that credit. They're tax-deferred. We purchase Bitcoin with those proceeds, and we hold it indefinitely. That's tax-deferred. Right? So it's a triple tax-deferred business model, scalable, new, never been seen in the history of the capital markets. That's why it'll take people a while to get their head around it, but it really is a beautiful instrument once you understand it. Let's go to the next slide. This digital treasury model allows us to create a digital credit factory. If you look at the company, what we're doing is we're manufacturing USD yield for credit investors, and we're delivering them that yield in the form of ROC dividends. So we're generating tax-deferred dividend yields in USD, and they're giving us capital. We are then buying Bitcoin with that capital. So we are funding the crypto economy. So the crypto economy is the 750 million people that are growing by millions every day that believe in pure global finance, and they're engaged in everything under the sun in 1,000 exchanges. So we fund that economy, and they return to us Bitcoin, and Bitcoin is 1/21 millionth of all of the capital in that economy. And so the credit investors get their yield, we get our Bitcoin, and then we're shipping and delivering BTC yield to the equity investors. So the equity investors want to outperform Bitcoin, and so the equity investors get amplified BTC exposure, which you can quantify via BTC yield. The credit investors, they get their USD yield. The equity investors, they're getting tax-deferred growth. The credit investors get tax-deferred dividends. It all creates a very powerful feedback loop. And, our long-term forecast is Bitcoin outperforms the S&P. I expect it'll go up 30% over a year for the next 20 years. So we're generating BTC NAV growth, and we're generating operating income, and that is tax-deferred. And so it's a very powerful business model once you understand it. Let's go to the next slide. If you want to quantify ROC dividends a little bit better, if you actually have $100 instrument, $100 credit instrument that pays you 10% at par, if you reinvest those dividends every quarter, and it's a taxable dividend, or it's a taxable coupon at 37% tax rate, and that's what a bond would be, or a money market, or a corporate bond, or a junk bond, you're going to have $187 at the end of the 10 years. If you get that payment in a qualified dividend and you pay a 20% tax rate, you're going to have $221 at the end of the 10 years, so it's 18% more. And of course, if you receive those dividends as ROC dividends and reinvest the ROC dividends every quarter for 10 years, you're going to end up with $269 at the end of the period, and that's 44% more. So clearly, ROC dividends are compelling for the investor, and they get more compelling as you live in a higher tax jurisdiction. And as the tax rates go up, they get even more compelling. Let's go to the next slide. So digital credit opportunities, how do you break this down? Next. This is Stretch versus every other credit instrument in the United States on average. What you can see is Stretch is offering 16.5% tax equivalent yield. The hottest thing in traditional credit is private credit. It's 7.6%. Investment grade bonds 4.7, money markets 4.1, commercial paper 3.9, your bank account 40 basis points. So what you can see is Stretch is offering more than double anything in the traditional credit market, but it looks sort of like 4 times better in the US. Let's think about all the digital credit instruments. What you see here is that digital credit is simply superior to conventional credit. Like the worst instrument or the lowest yielding instrument we have, STRF, Strife, has got a tax equivalent yield of 14.4. It's double the best thing in the traditional credit market. Stretch is quadruple. Stride is 5 times, what you'll get from a money market. And Strike is even higher after you adjust for the equity component. So you can see these numbers are off the charts, and it's going to take a while for credit investors and for the market in general to adjust and digest this. But we believe that digital credit is the killer app of digital capital. And we believe that the most compelling business model is a digital treasury company built on digital capital, issuing digital credit. And this chart shows you why. Now, this is the US. The US has the highest risk-free rates in the Western world. So let's look at the next chart. What I'm showing you here is the Stretch rate. It's our short duration, sort of 1 month adjusting credit instrument versus the 1 month rate for the US dollar. And then let's look at, at the currency in Australia. It's 3.5%. Canadian 1 month rate is 2.7%. Korean won 2.5. European 1.9 and falling. Singapore 1.4, JPY, the yen is 50 basis points, and the Swiss franc is negative. So what you might take away from this is that we have an opportunity, not just in the US, but in the Middle East, in Great Britain, in Australia, in Canada, in Korea, and everywhere in Europe, in Singapore, in Japan, and in Switzerland. And we're studying each of these markets, and we're thinking very hard because we can create a digital credit instrument in Great British pounds or in Canadian or in euros or in Swiss francs. So we create the currency we want, we put the appropriate amount of risk on it, we strip away the duration, and then we start selling pure yield. That is the compelling use case. And so are we on a mission? Yeah, we're on a mission. We're on a mission to basically give everybody a bank account that yields 10%, or in this case, a money market that yields 16.5% tax equivalent, right? We want to change people's view toward money, change their view toward credit. And it's not very complicated to figure out why you might want to do it. And I don't think it'll be complicated for people to figure out why they might want to own these instruments. Next slide. So let me just end with an observation. We're in the business of creating digital equity by harnessing digital capital and using the digital capital to create digital credit instruments. So the equity, MSTR, is digital equity. If you want amplified BTC because you kind of want enhanced exposure to digital capital and you want exposure to digital credit, then you would buy the equity. The price you'll pay is 62 vol. It'll be very volatile. Now, the next option you have is Bitcoin. And so let's look at that. If what you want is to strip away the counterparty risk and the currency risk, right? And you want a long-term store of value, you don't buy the equity, you buy BTC, and that's 42 vol. Now, what if you want a mixture of upside and quarterly income? You would buy Strike, 28 vol. If you just want to maximize your cash flows, then you would buy STRD, 16 vol. And if your idea is you want the highest seniority and the greatest degree of investor protection, then you would go to Strife and you get a lower vol, 14 vol. And then the final option, of course, is if you're looking for stability, simplicity, and minimal volatility, you go to a treasury credit instrument, which is STRC, Stretch. And when you put all these things on the same chart, I think it becomes pretty clear what we're doing and why we're doing it. And every one of these instruments is aimed at a different type of investor. We couldn't create the credit without the equity and without the capital. And of course, they're all reflexive, right? The more credit we sell, the better it is for BTC and for the equity. And, and as the equity appreciates, that's good for the credit and that's good for BTC. And as Bitcoin appreciates, that's good for the credit, that's good for the equity. So it's a very elegant business. We're very blessed, and we feel honored to have the opportunity, and couldn't be more excited about it. Let's go to the next slide. So what I would say here is, if you're not sure what you want, and you've listened to me so far, then you want Stretch. Right? For those people that aren't sure what they think about Bitcoin or how they feel about the company or digital credit or anything, right? The simplest idea is 10.5% dividends paid monthly for those who like money. It's just that simple. You like money, you trust the company, but you don't understand anything else. You collect 10.5% dividends. They're tax deferred. They're paid monthly. Tell your friends. And I'll just end with our last slide, which is our principles that I want to remind everybody. Our principles are to buy Bitcoin, hold Bitcoin, treat all our investors with respect, prioritize the equity, generate positive yield, innovate with fixed income securities, maintain a healthy, robust balance sheet, promote global adoption of BTC as a treasury reserve asset. And I want to thank everybody for your time and also for your support. We couldn't do it without you. Thank you.
Thank you, Michael. We are now going to proceed to the interactive live Q&A session of our webinar. I would like to invite all of our Q&A guests to come on video. And we look forward to hearing your questions. We'll go one at a time. I'll call your names and you can direct your question to the management team. For the first question, I would like to invite Andrew Hart, a research analyst from BTIG. Andrew?
Hey team, thanks for having me on. I appreciate all the details in the presentation as always. So, a lot of our investor questions are focused on the company's ability to pay dividends, especially as the preferred equity strategy continues to grow. Can you just shed some additional color and light on plans to fund those dividends? And then, if there was a period where the MNAV, compressed or was even below 1 times, how could that plan potentially change? Thanks and appreciate it.
Yeah, I can cover this one. And, Andrew talked about this a little bit earlier. Right now, uh, our dividends and interest on our convertible notes total $689 million annually. And our primary strategy, when our MNAV is above 1, is to fund that through ATM issuances. And just to remind everybody, in the last 12 months, we've issued about $27 billion of equity, which means that that's about the $650 million or so is about 2.6% of how much equity we've raised. So we clearly have the ability to raise equity to cover our dividend payments and our interest. Now, the big question is what happens when it becomes dilutive to shareholders to issue equity. And when we're below 1x MNAV, or if we go below 1x MNAV, what would we do? And there are other things that we've explored and talked about. We could sell equity derivatives, we could sell Bitcoin derivatives, and we could sell high basis Bitcoin to cover our dividend needs for our preferreds. What's important when we do those things, and we've talked about it, is we want to preserve the ROC dividends on our preferreds. So we'd have to do them in ways that are avoid positive tax E&P, right? We wouldn't do things like sell, equity or Bitcoin derivatives that would cause our E&P to be above 0. We are able to sell high basis Bitcoin potentially at a loss and cause negative E&P and offset that with other Bitcoin that would cause positive E&P. We wouldn't sell the software business. I know there are questions about that because that would cause income and positive E&P. And so we want to preserve the ROC dividends, the preferable tax deferred treatment of our preferreds. So those are some of the things that we would do in that scenario. We don't anticipate that scenario, but we do have plans in place.
Thanks, Phong.
Thank you. For the next question, I'd like to invite Pierre Rochard.
Hey, thank you for organizing this, and thank you for the invitation. It was mentioned that there would be marketing and advertising around the preferreds. What do you anticipate that expense looking like, and what the return on investment would be for those efforts?
I can cover that. We're just starting to get into this. You just saw one of our advertisements for those who like money, Stretch, right? And so we'll start to experiment with paid advertising on platforms like an X or a YouTube. I think whatever the expense is, it would be quite minimal compared to the increased inflows that we hope to drive into our preferreds, right? And I think we've gone through in the past, if we're able to raise an incremental $1 billion in a preferred, we immediately turn around, buy Bitcoin, and that's immediately accretive to Bitcoin yield and Bitcoin per share. I don't expect we're going to spend a ton of money upfront. We'll experiment and see what are the right channels and what causes people to wake up and understand the Bitcoin credit machine that we have. And then in addition to just digital marketing, we're out meeting with investors, meeting with potential investors quite a bit now. And I think there's just about a feet on the street between Mike, myself, Andrew, Sharish, CJ, and the entire team.
Yeah, I would just piggyback on that by saying I just spent a lot of time in the Schwab studios and recording content that go on the Schwab network. I was in Vegas at Money 2020. I was in Austin at a credit conference. I'll be in Naples, Palm Beach. Got a big road show throughout the Middle East for a week and a half coming up. So there's a lot of outreach. We get invited to speak at a lot of conferences. We also get invited to speak on television, right? So, some of the better marketing channels is just go on Bloomberg, go on Fox, go on CNBC. And I think that the difference between what we're doing now and what we were doing a year ago is a year ago, people said, well, what is Bitcoin? Is it going away? And can you sell me on Bitcoin? Now we're beyond the Bitcoin going away. Everybody's embraced it as digital gold. Now, when we go on Bloomberg or Fox or CNBC, we're saying, stretch, it's 10.5% dividends tax deferred. You might want to check it out. So we have it. By the way, you know how I used to say it takes 1,000 hours to understand Bitcoin or 100 hours to figure this out? It doesn't take that many hours to figure out that something that yields 10.5% tax deferred is better than your existing money market or bank account. So we've got simpler messages, and we're taking them to every channel. We will try TradFi. We don't think we can sell the Bitcoin message in 30 seconds to 70-year-old conservative traditional retirees. But we do think that we can sell stretch in 15 seconds or 30 seconds to military retirees, that want to live happy ever after, and we know this anecdotally because it's happening everywhere we go, everybody we talk to, it's the simplest product for us to explain. It's hard to sell convertible bonds. It's hard to sell 30-year crypto bonds. It's hard to sell, Bitcoin to the rank and file, but everybody wants a bank account that pays 10% that you don't have to pay tax on. So, we're going to work every possible marketing channel and in order to get the word out. And the good news there is we're getting an avalanche of requests to speak. Everybody wants to talk to us now. Right. So just around the time that everybody wants to interview us, everybody wants to talk to us, we have the simplest message. You can put it in 30 seconds. And so it's a very exciting time for marketing.
Thank you, Pierre. For the next question, I'd like to invite Mark Palmer, a research analyst from Benchmark.
Yes, thanks, and thanks for taking my questions. We have already seen the beginnings of consolidation within the digital asset treasury space. Is there a circumstance under which Strategy would step into the market as an acquirer of a Bitcoin treasury company that was trading at a materially lower MNAV in a transaction that would be, by definition, accretive as a means of accelerating its acquisition of Bitcoins?
I'll give my opinion, and then Phong can chime in. We've done 84 acquisitions of Bitcoin, and every one of them was homogeneous, transparent, and you could instantly calculate whether it's accretive or dilutive, and they were generally all accretive. And our focus is to do high-speed, transparent digital transactions, and sell digital credit and buy Bitcoin. And we think that it's a big advantage of the company that the business model is so transparent, predictable, clear. Because the business model is predictable, that makes it easy for the equity analyst to make their decisions. And it also makes it easy for the credit analyst to assess the credit quality. So generally, we don't have any plans to pursue M&A activity, even if it would look to be potentially accretive. It might be, but there's just a lot of uncertainty, and these things tend to stretch out 6 to 9 months or a year. And an idea that looks good when you start might not still be a good idea 6 months later, and it can be very distracting for the management team while you're either integrating or pursuing those things. So our management team is laser-like focused on selling the 4 credit instruments that we have, and then expanding the reach of our digital credit instruments internationally and of course, improving the quality of our balance sheet, equitizing the convertible bonds. Those are all the things that we're very excited about. As an operating company, the great thing about operating companies is, yeah, you have the option sometime in the indefinite future to do something. And if you're walking down the street and there's $1 billion and you can bend over and pick it up for a nickel, you have the option to do it. And I don't think we would ever say we would never, ever. But what we would say is the plan, the strategy, the focus is sell digital credit, improve the balance sheet, buy Bitcoin, and communicate that to the credit and the equity investors. Phong, you have anything to add on that?
No, I don't have anything to add. I would generally agree with what you said. We've been a software company for nearly 30 years or over 30 years, and software technology M&A is very difficult. There's always something hiding behind what you actually think you purchase. And I think that I would say that the same thing is about acquiring Bitcoin treasury companies.
Okay.
And just one more question. With regard to your intention to tap international markets from a capital raising perspective, is the idea that you would effectively market the same for perpetual preferred instruments that you currently have, but just to different markets around the world? Or would you be designing new instruments that were specific to those geographies? Thank you.
It'll be the latter. We will design, if we're going into Canada, we would design an instrument that's denominated in Canadian CAD, and we would offer it to Canadian investors on a Canadian exchange. So it'll be a native product, because if you're the investor there, you don't want to take currency risk. And if we go into Europe, we would create a euro-denominated instrument. And we would offer something that represents everything we've learned from the first 4 credit instruments. If we could improve it, we would. But primarily, the Europeans want a euro currency instrument in Europe, and every international investor does. What we've discovered is, a lot of European investors, they can buy the American instrument. So if they wanted a USD dollar-based treasury credit instrument, they would buy Stretch. And so they can already get to it. In fact, one of the more pleasant surprises I learned is we accumulated a ton of European and British investors in 2020 because they could buy MSTR and they couldn't buy Bitcoin. So our digital credit instruments are already global. If you want US dollar credit instruments, then you're already buying them globally. We think the big unlock is that we can create a digital credit in any currency. We can take JPY risk, or we can take euro. We can solve that problem. And there's people that will buy $1 billion of something if they don't have to take the currency risk, and they'll buy nothing if they have to take the currency risk. So our job is to bridge that capital divide. And so when we do it, we'll do it with a native instrument and a native currency on a native exchange that is going to be presumably the most compelling credit instrument in that capital market that anybody's ever seen.
Thank you, Mark. For the next question, I would like to invite Natalie Brunell.
Thank you so much for including me. Beyond Bitcoin price action, can you identify 2 or 3 very specific challenges that are serving as headwinds for the growth and performance of Strategy and even the Bitcoin treasury industry more broadly, and what actions can be taken to overcome those?
I think Phong highlighted some of them in the discussion of S&P credit ratings issues, right? The fact that Bitcoin is not viewed as capital by the traditional credit ratings industry. So I think the view of Bitcoin and the collateral value of Bitcoin and the traditional views under the Basel rules, under the rules that govern our banking system, our insurance companies, and our credit rating agencies, I think that that's a structural thing. When when FASB didn't allow you to recognize gains, but they made you recognize losses, you didn't, and you had indefinite intangible accounting, that was pretty crippling. I think that we fixed that, and I think that fixing capital risk rules, will be a big one. I think the second is banking acceptance, custody, and credit, banks issuing credit on Bitcoin. So we're hearing rumors, and we've heard, that a number of major banks in the US in the first half of 2026 will start to buy Bitcoin, sell Bitcoin, custody Bitcoin, and issue credit and margin lines against the native Bitcoin asset. That will be great for them. That will be great for Bitcoin. That will be great for us. That will accelerate adoption. And so I would say that neither of these are things that I would ask for government help for. Like, we don't need a law to fix it. What we do need to do is lobby the banks, lobby the insurance companies. Maybe I should replace that word with educate. Educate the banks, educate the insurance companies, educate the credit rating agencies. And then finally, educate the traditional fixed income investor, the retiree, and the corporate treasurer. Educate them that there actually now is a better option. And so I think that's what we need to do in order to grow the industry right now. That's going to be our focus over the next few years.
Thank you.
Thanks, Natalie. For the next question, I would like to invite Brian Dobson, research analyst from Clear Street.
Yeah, so you received a credit rating, and I agree that that's a very important first step to opening doors at pension funds and insurance companies. I know it's very early days, but are you already having conversations with those investors? And if so, what's the feedback? And then as a second part to that question, would you have the preferreds and converts rated separately? I mean, I think a lot of investors will probably just infer instrument ratings from the general company rating, but what are your thoughts on that?
I can start on that, Brian. We had, before we received a rating, conversations with large institutions, insurance companies, pension funds that said that they could not easily, without significant capital penalties, invest in an unrated instrument, and that they were quite interested in the structure of what we provided, but just couldn't do it. So that was why we went and pursued a rating with a major rating agency. It's one of the reasons. So I do think this opens up doors to some of the categories that you just mentioned before. And I think, it's not going to be an avalanche like tomorrow, but as we go out and market, and Mike has discussions, and I and Andrew all go out in the market, and we start talking to these folks, I think their thought process will certainly change over time.
Yeah, and then I just wanted to follow up on an earlier question about selling into Asia and Europe. Both of those markets represent or have, rather unique regulatory hurdles. I guess, how far along are you in those markets?
We're pretty far along, and you're right. That's part of the reason why we need to create products that are very specific. What exchange? Is it retail focused? Is it institutional focused? Is it regulated? Is it unregulated? What is the tax regime? Look, what we've done since the beginning of the year with preferreds is we went uphill against a market that wasn't familiar with a Bitcoin-backed perpetual preferred with a return of capital tax structure. And it took us 9 months, and we were able to raise $6.5 billion or $6 billion, right? And because we did that, I think we've sort of cornered this market for a good period of time. I think our ability to go understand the regulatory structures, the tax structures, it's harder than in the US. But once we've broken through that, that creates a competitive moat for us to be able to offer products that clearly are superior to what's out there. So we welcome the challenge, I guess is what I'd say.
Great. Excellent. Thanks a lot.
Thanks, Brian. For the next question, I would like to invite Adam Livingston.
Thanks so much for having me. Congrats on the great quarter and the credit rating. The Japanese Bitcoin treasury company MetaPlanet has recently announced a share buyback program with the intention of being able to strategically deploy buybacks at times that would increase Bitcoin per share for the equity holders. Would Strategy ever consider adopting a similar program as means to increase Bitcoin exposure for shareholders if MSTR ever trades below a 1x MNAV?
Phong, you want to start?
Yeah, I'll start with that. I don't think there is anything that we wouldn't do that would create incremental Bitcoin yield that increases more Bitcoin per share for our shareholders and preserves our ROC dividends for our preferred holders, right? And so we have an open buyback authorization already. We've done it a long time ago. I think the last buyback we did was 2018 or so. It's not our primary strategy, but it's an option if we were to go down that path. Mike, you want to add anything?
Yeah, I would say we're open-minded toward a variety of options. Right now, our preference is to grow the capital base, but if it was compelling enough, we would look at it.
Thank you so much. Appreciated.
Thanks, Adam. We have 2 more questions to go. So for the next one, I will invite Lance Vitanza, our research analyst from TD Cowen.
Thanks, guys. The 30% BTC yield target for 2025, I'm surprised you maintained it given the recent decel in Bitcoin accumulation. Getting to 30% would seem to require you to raise at least another couple of $2 billion, and we only have 2 months left in the year. You're not going to get there on ATMs alone. Are you currently contemplating a big underwritten transaction, perhaps in an overseas market? Is that sort of how you get to the 30%?
Yeah, we need to raise roughly $2 billion, in a non-dilutive fashion to our of capital. And you've seen us do that at quick pace in a short period of time. We have 2 months left to go. And so we'll be racing and we'll see what we can accomplish, right? We're always working, always trying new things, developing new things. And this credit factory that Mike talks about, we're very bullish on. Obviously, we can't say exactly what we're going to do when, but it's 2 good months, 60 days, right before the holidays.
Great, thank you. And for the last question, I will invite Ben Workman from Strive.
Thank you, Shirish, and thank you guys for taking my question. Over the last 12 months, Strategy has been extremely successful at building the capital base and expanding the balance sheet using primarily equity in the IPOs from the preferred markets. And over that 12 months, you saw MSTR underperform Bitcoin in a fairly significant manner. Do you guys view the strategic priorities moving forward as focusing more on increasing amplification and less on expanding the balance sheet? And how has this past year informed your go-forward strategy and how you might prioritize the prefs over the common equity moving forward? Thank you.
Yeah, that's an open-ended question. So I'll start and then Phong or Andrew may have something to add. Yeah, clearly, with equity, I would say if you're going to own Bitcoin, you need a 4-year or longer time horizon. If you're going to own amplified Bitcoin, a company that aims to be more volatile than Bitcoin, you can't have a lower time horizon. So you probably need a longer time horizon. So we manage the company such that we think 10 years from now, we're going to create an insane amount of shareholder value. And that doesn't mean we're looking for 10-year payoffs. We're generally thinking if it doesn't return what we expected within 4 years, we'd be very disappointed. But we never do anything where we demand to get the payback in 4 months. And so we don't have a 4-month time horizon or even a year time horizon. And we think that generally, I would say if your time horizon is 12 weeks, you should own the STRC, right? You really should go to the short end of the risk curve and the short end of the duration curve, because that one we're trying to strip volatility away. And if your time horizon is 10 years, and if you are Bitcoin maxi, then maybe you like the equity or you like Bitcoin. The credit instruments, I would say, if we wanted to raise the max amount of capital, then we could do two things that we don't do. One thing we could do is we could just open up the ATM and we could sell stock at any MNAV any week all the time. And what you've seen is we don't do that. You know, after the red sweep, when there was a massive enthusiasm, we would sell $1 billion or $2 or $3 billion of stock, like a billion in a week or 2 billion in a week. And so you see, we're not shy when the market is strong and the premiums are high. We would go very hard, but you see a lot of weeks where we sell nothing. And we could have sold $1 billion of equity a week. We chose not to sell any equity. If the equity is weak and it's crashing, it's almost certain. In fact, it is certain we're not the ones doing it, right? We're watching, right? Because our view is we only sell into strength, and we only sell into strength when we like the premium. So we have actively decided we don't want to maximize capital by selling equity. And then I think the other thing is, just like we could raise $1 billion of equity in a few days if we wanted to, I could also pick up the phone and I could raise $1 billion overnight in debt. If I just said we wanted to do a pipe deal with a debt investor, I would have 12 firms over the weekend. And by Monday morning, we could have raised $2, $3, $4, $5, $6 billion. They would be licking their chops and delighted to give us the capital. They would want to be senior to all the other creditors in the capital structure. And what they would do is they would undermine the creditworthiness of the preferred instruments that we actually want to sell. So you could just assume with our 75 billion of capital right now, we've already chosen not to raise 20 billion or 30 billion. We could be $100 billion, but we'd be 100 billion, and the risk profile, you know, the leverage wouldn't be 11%. You know, the leverage, you know, would go up, you know. And so we actively decided that we don't want to generate leverage, right? We're literally on a path to drive leverage down. We're also on a path, we've decided we don't want to do deals that don't have positive BTC yield. But more importantly, we're on a mission. The mission is to create the digital credit market. So I think the company has two speeds. Well, maybe more than two speeds. When we're coasting, when the credit markets don't offer us anything compelling and the equity markets aren't compelling, we are coasting. And in my mind, I think that is a $75 billion company growing 30% a year for the next 20 years. So that is in idle. And then for those of you who know me, you know I believe in the Hippocratic Oath, do no harm. And so the risk-free rate, the company is going to get the 30% a year for 20 years if we take no risk. So what can we do where we feel like it's worthwhile? And of course, if we sell credit, we can take that 30% to 40% or to 50%. But we have an agenda here. The agenda is not to artfully manage the balance sheet. It's like if you told me, well, you could issue $10 billion of junk 5 to 7 years and roll them every year and roll them every quarter. And you could pursue a credit strategy based on debt that gets you a lot more capital and you're continually rolling it. And you would do that with 144A offerings. We could fire up a $2 billion 144A offering next week and we just go do it. But the point is, we don't want to be the revolutionary company that adopted digital capital that grew the company with conventional traditional credit. We want to be the revolutionary company that discovered digital capital that then went on to discover and found the digital credit market. And, when you're just rolling a bunch of 5 to 7 year bonds and when you're opportunistic, then, you're careening toward the future with an advantage. I want MSTR to stand for monster. We want to create a monster company. We don't want to careen toward the future with an advantage. We don't want to be the talented fighter, that kind of wins and loses and mostly wins and is a little bit sloppy and undisciplined. We want to create the digital credit instruments that are 2 to 4 times better than everything in the $300 trillion market. And we want to eat the world, right? And we want to sell $100 billion of them. And after we sell 10 billion, then 20 billion, then 40 billion, then 80 billion. When people go, well, aren't you levered? We want to say, well, actually our leverage is 0. Huh? What? Wait, what? We have 30% amplification, but we don't have 100 billion of debt. We have 100 billion of equity that happens to actually amplify the common equity. Let me educate you on a new way to build a company. So I would say you want to boil that down. It's a very disciplined growth strategy. We would rather coast and have a bulletproof balance sheet and a $75 billion company growing 30% a year than to stretch for capital or stretch for some kind of yield, but undermine the balance sheet and take on credit risk. Because, someone says, I'll give you $10 billion tomorrow, and it's senior to STRC. We just created volatility and we crumpled the credit of the instrument that is going to provide a comfortable retirement to 1 billion people. I don't want to be the dude that made a good trade that made 25 or made $50 billion by trading Bitcoin by using cheap corporate money. We don't want to be the company that made 25 or $50 billion or a Hail Mary, or maybe we lost it by whatever, borrowing money, however we can get it to buy Bitcoin. We want to be the company that provided a comfortable retirement to 1 billion people and changed the world, right? We want to change the monetary system. I want everybody to get up in America and say, I'm not getting paid 10% tax deferred from my bank or from my money market. That's not fair. That's an abomination. I'm going to tell all my friends that I'm so mad about it. I'm going to go tell my 100 people that I know, they all need to pull their money out of the money market. They need to buy Stretch. And we want to be in a position where we can accommodate that demand. And so what you have is the money that comes easy is always the money that comes with strings attached. And I've learned that over 35, 40 years. And I think that people in the Bitcoin treasury market, they're learning it now. The easy money is the toxic money. What you really want is you want to create a revolutionary new product that solves a problem for $300 trillion of investors and for billions of people. And you know what? When we sell $1 billion worth of digital credit, they're giving us the money forever, and we're taking no credit risk. But the quid pro quo is we're giving them 10% tax deferred, right? And so I would rather pay 10% tax deferred and get the money forever than pay 5% and get the money in the form of a junk bond and pay a taxable 5% coupon, even if you wanted to give it to me. And Ben, you can see the obvious reason why. The world's full of 50,000 companies that will give you the 5% taxable. How many companies are in the world that will give you 10% gleefully, enthusiastically as a rock dividend, and then do everything in their power to actually issue more dividends? So for us, the credit is the product, right? The aspiration or the offering is a comfortable retirement to everybody who's a credit investor. That's the offering. If we can do it by selling equity, we will. But when the equity is dilutive, we won't. And we won't do debt, because debt is a conventional credit idea. It's a 20th century idea. I think I laid out with my 7 differentiators for digital credit. We think that digital credit is an inversion of everybody's value system. Every other credit issuer in the world gets up and says, how do I cripple the credit and pay you the lowest coupon and maximize the advantages to my company? And we get up every day and say, how do we create the greatest credit instrument that pays the highest tax equivalent cash flows that's going to be best for the buyer, right? For the investor. So that's the answer to your question, hopefully.
Thank you.
Excellent. So this concludes the Q&A portion of the webinar. I would like to thank all of our analysts for their questions and all the attendees for tuning in live. We had over 25,000 people across YouTube, X Livestream, and the Zoom webinar. So thank you all for joining in. And I will now turn the call over to Phong for the closing remarks.
I also want to thank the analysts for joining us and being on video and asking questions. I want to thank everybody who watched us, our earnings call, and all of our supporters and all of our shareholders out there. And I invite you all to join us in Las Vegas, February 23rd through 26th at the Wynn Resort.
Go.
And for everybody else, have a great holiday season. And we'll see you in 3 months at our next earnings call. Thank you.
Damn, the 23rd to the 26th is unfortunately, it's during the week. Let's make sure I exit out of the. Oh, that was a Zoom call. Oh, wait. No, I did it on YouTube. Hold on. Let me find it and close it before it starts playing something that I can't hear anything. I think this is it. That's Sam's call. Let's see. Is this anything that I need? No. Close that. But yeah, I think there's a lot of things in that call, particularly that showed up healthy, in my opinion. So it wasn't on that one. Let's see, on this one. Okay, here we go. Strategy. Very good. So yeah, let's just go through what particularly is highlighted on that one, and then I'm sure there's a few clips that I want to see on CNBC to see what other people's reactions are. Unfortunately, I didn't have the opportunity to chat with Amit or anybody, but I might call Steve before I close this out. But some things from the strategy call that we just finished up. Bitcoin treasury companies looking to expand capital products to international markets and access more capital pools and buy more Bitcoin. They were talking about creating additional products for, say, Canada or Europe denominated in their particular currencies. I think that that's a bold strategy, but I think it's warranted to see what potentially can occur. They've obviously done a pretty decent job so far doing so with the US dollar. So curious to see how it shows up in other markets as well. Strategy has met all the inclusion criteria to be included in the S&P 500, which includes obviously U.S. company and it's U.S. listed, a above $23 billion market cap, which it is, and 250,000 shares traded each month for 6 months. The last quarter being positive earnings, and then the last trailing 4 months being all positive. Now, of course, that happened specifically because of this large increase in the quarter, this particular quarter, with obviously being like a 30-odd billion operating income quarter or something of the like. I forget what it was, something massive, 20-odd billion. And that was because you're able to now count Bitcoin on the balance sheet as gains versus what it was in previous quarters where you couldn't, right? And so there's that particular impact to the bottom line, which obviously means that they have the potential to now be included in the S&P 500. That their 30% Bitcoin yield for the year is based off of a reaffirmation of the $150,000 Bitcoin price by year-end 2025, which would generate them an operating income of $34 billion and an EPS of $80 per share, based off of today's kind of acquisition that they have of 640 or so thousand Bitcoin. There are now over 200 public Bitcoin. There are now over 200 public companies holding Bitcoin on their balance sheet. Per Michael Saylor, they talked about basically in the just short while ago, 4 or 5 years ago. They were the first to really publicly announce it, and then since then they've really grown in terms of total numbers. Last thing I had is Michael Saylor saying that he wants MSTR to stand for monster, basically saying they want people to be able to look at and have the access to liquidity to Bitcoin comparable to what's been going on in the United States. And so with that, they have the ability to potentially denominate things in, say, the yen, the euro, the Canadian loonie, etc., that people will be excited, right? 10% yields are something that should get everybody excited, potentially if they're able to be sustained. So if you're comparing yourself to a bank per se, which trades at, say, 0.4% for a checking, or if you're lucky, 2 to 3% for a savings, you have the opportunity to grow that to 10% yield. That can be hugely beneficial. And then one thing that I noted here that Saylor said, which I really, really enjoyed, is we don't have a 1 month time horizon or a 1 year time horizon for MSTR specifically. I think he was talking about the equity on that. And paraphrasing was around Saylor and the rest of the executive team saying that they generally buy Bitcoin in a 4-year horizon, right? So they said basically that if over a 4-year time period, if they didn't generate returns on that Bitcoin, then they would be pretty upset by it. And so they basically stated that that's what the other products are for, right? The other products are specific around if you wanted to get something like a monthly yield or something, you buy Stretch, STRC, or you want other sorts of yield, you would buy Stride or Strike. Those are the types of products that you would potentially look for, and giving that flexibility and change of volatility associated with it. So very interesting. So before we close it out, let's take a quick look at maybe some of the clips that have shown up. I'm curious to see specifically on Apple earnings what the reaction was. So for a second.
Overall, there's not a lot to pick at in terms of the quarter guide, but when Tim Cook is smiling, talking about the results, I know that it irks you.
Of course
so
you're smiling.
To you and
I'm smiling ear to ear, baby, smiling ear to ear.
If you wanted to say, hey, but wait.
I'll give you a few hey,
what?
but waits. Now, people will say the numbers are astronomical. We'd never dismiss the numbers. They are $102 billion, record quarter in revenue. Absolutely. If you look at their services now, 27% of overall revenue, tremendous growth there. 76% margins in services. They deserve it of a higher valuation. But then you say to yourself, well, wait a second. They're still growing high single digits, maybe low double digits revenue, mid high single digits, low double digits earnings growth. And you're paying at this price almost 34 times next year's numbers. So the numbers are great. It's the valuation that should still be concerning, despite all those accolades I just gave out.
Not concerning to people in general. I mean, the stock's up 30% going into earnings over the past 3 months. 52-week high in today's session.
Yeah, if you don't care about valuation, and I think in a market like this, really people don't. I think with a company like Apple, you want to see this move back towards double-digit hardware sales, or iPhone in particular. They haven't had that in a very long time. And to Guy's point about accelerating services, getting back to that 20%, I think one of the biggest differences.
I think we're on the phone with Steve. You hear these sirens? That's not me. That's the clip.
But the hyperscalers and the like, we've been going back and forth. Is this CapEx over the last couple years? Is it good? Is it bad? Is it misallocation of resources here or there? You're throwing caution in the wind. Apple, as a percent of their revenues, their CapEx has been tiny, and it's been tiny relative to that of their big mega cap peers. Now, you could say that's bad because they're not building the infrastructure they're going to need going forward. You could also say it's all going to be commoditized and they're going to be able to build businesses on the back of it, and I think that's probably what's coming out right here. I don't think that this cycle on the hardware, while it is good, I don't think it has much to do with AI in general. Like, let's see what the Siri rollout. Let's see what some of the services that are built in and around it. Let's see who they partner with. I think this is going to be really important. But I do ultimately believe that if they're in a partner with Gemini and they have that deal with Google Search on Safari, I think that's probably the best bet for them going forward. And then let app developers figure out what the experience is going to be on an iPhone.
Does the valuation of Apple concern you, Courtney? And relative to, what we got from Meta yesterday, where CapEx is going to, increase notably next year with no fixed number given, at a lower valuation than Apple with a higher valuation. I mean, which one would you prefer?
Yeah, I think that is the problem with Apple. It is the valuation and the no AI story. So I do think it's good that you are going to continue to see these iPhone sales that are picking up. We were hoping that was going to happen with the iPhone 16. It didn't happen. It's hopefully happening with the iPhone 17. I do think it's concerning seeing how there aren't any the China sales were actually quite a bit of a miss there. But hopefully that's going to look better moving forward. But as good as the numbers look, I just don't think it justifies that kind of evaluation. I do think compared to Meta, which just reported, people are anxious about the amount of CapEx spending and at what point they're going to monetize that. And I think that's been a positive for Apple because they don't have it. So I don't think it's a benefit for Apple. It's just like if you're going to compare the two and you're worried about CapEx, well, maybe you look back at Apple again. And that's what happened back in April. If you remember when people were concerned about it, Apple was doing fine. You're kind of starting to see that trend pick up again.
I mentioned the run into the earnings, Carter, of Apple. You could have easily seen a reason to sell in the news kind of event. What does the chart look like?
Well, what do we know? That Apple has been a major laggard, right? Its relative performance to its sector peaked in 2022, and it has been playing catch up ever since. The stock is only just now breaking out above its pre-tariff sell-off high. So that high was 260. It lost some 34% in the tariff sell-off, much more than the S&P. It has now recouped that loss and is only slightly above where it started. I would play for higher prices.
Interesting. Let us see if we can get the Stephen Fiorillo on the line. Let me see. Hold on. Let me mute real quick. All right, Steven's in the middle of eating. Very good. So he might join us in 5 minutes. I should have messaged him like 20 minutes ago or something, but he might come on and then give us his thoughts. And then when he gives his thoughts, I might be getting my food here. I ordered some chicken, rotisserie chicken to be here. And when that shows up, maybe I'll just hang out in the background. And so the Milkman Wrangler, I like that. So yeah, Steve will be on. So apologies. I was on mute. I just, I don't like putting people on the spot, because it's happened to me before. Never that it's bad or anything like that. It's just, Steve and I have good conversations and we vent to each other, right? So I don't want sometimes some of that stuff, showing up, let me tell you about this. Like I need to tell you about my day or whatever, But yeah, let's look at some other things that are coming out. Oh, I want to hear about the Amazon earnings. I obviously thought the Amazon earnings were absolutely phenomenal. So I think some people are sitting here thinking that Amazon didn't do well. The trailing 12-month ops income to me continues to do extremely well. I was just doing some back of the envelope math. Somebody was like, Matt, I don't understand why you think this is going to be a $10 trillion company. And I'm like, how can you not? Right. So let me just do some back of the envelope math for you. Right. We're at just under $700 billion run rate in the trailing 12 months. By the time we get to year end 2025, we'll be over 700 billion. Right. So we're not far off at this point. And if you continue to grow at the 11 or so percent rate, 12%, or if you have any sort of acceleration, then it's not going to take long. It's going to take 3 or 4 more years for you to get to $1 trillion in run rate. And by the time you get to that point, if their ops margins is maintain where they're at, you're going that's just, where they're at, right? They're going to be making $180 billion in ops income. To me, 180 billion in ops income is worth, at a minimum, a 25x multiple for me. We're still after hours, $251 a share here on Amazon. Now let's just take the fact that, let's just say you get to $1 trillion here in the next 4 to 5 years, and you get to a 25% ops income margin. That's $250 billion, right? So $250 billion. Wow, that's $250 billion in ops income. That's a lot, but multiply that by a 25x multiple. That's a $6.2 trillion market cap. And you think that's not that difficult to do with AI and a lot of other things, especially now they're going to start focusing on getting their margins in a better place, right? They were talking about how the organization was set for growth between 2020 and now they're really focusing on the culture of getting it back in line. You think about it, that's going to add a couple percentage points. Yeah, some short-term hit, obviously, as you saw, a couple $1 billion in severance. But you think about the efficiency gains associated with that. That alone, let's just say that 2.5 billion is an annualized number, right? That alone is a $60 billion add, right, to the potential market cap of the organization. So that's huge in that respect. Now, let's just say, for example, you give it a little bit more of a time horizon, right? Give it 10 years, right? So you're able to grow, let's just say 700 billion by the end of this year. And let's just say you're able to grow at 11% for the next 10 years, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? And that puts you at the year end 2035. If you're able to compound at 11% growth rate for quite some time, and I know that's asking a lot, maybe you slow it down a little bit, but let's just hear me out a little bit. And you have that same 25% ops margin, you're going to be making $500 billion a year in ops income. 500 billion. Now, let's just give it some leeway and say we're only making 400 billion instead of 500 billion, right? So it's not too much to ask for. That's 2.5x from where we are today, right? So we're at about a 130 in TTM. That's a 3x from where we are today. So 400 billion, multiply that by 25 multiple. What does that get you? I'm waiting in the chat. 10 trillion. Not like we're multiplying things by 50x or 60x or 70x. We're multiplying by 25. And 25 for a premium business, a number one business in e-commerce, a number one business in cloud, a number one business or a growing number one business in advertising, or a top 3 business in advertising, a top 3 business in robotics. That deserves a premium of 25x multiple, in my opinion. In fact, I think you could even do more than that. So, with this current share price, right? We just say $250 a share. There's 10.9 billion shares outstanding. That's a $2.7 trillion market cap. So, I mean, if you get to that 10 trillion, okay, now that they're at 10.9, You know, it's only $9.17 a share. So hang me, okay? Hang me because it's $900 a share, not $1,000, okay? But eventually, I don't think that they're going to be able to grow capital expenditure above. I mean, maybe I'm being stupid. Maybe I'm being stupid. I didn't think that they would be able to grow capex above 100 billion, and now they're talking about for fiscal year 25, literally the quarter that is ending in 2 months, 60 days time. They're talking about 125 billion. That's insanity. That's the market capitalization of like pretty much every company in the S&P 500, less like the top 40, top 50 maybe. So you're talking about spending in capital expenditure, not, you know, profit or anything. Capital expenditure, meaning investing back into the business. Anyway, it's insanity. It's insanity. So let's hear what they have to say on CNBC, because I was flabbergasted by the whole Amazon call.
Guy, finally, it beat expectations on AWS.
And good for them. And I'm looking at this. Remember, there were days when we used to do the show where operating margins for Amazon were 3-4%. 12% operating margin. So they're obviously doing things the right way, and it's deserving of even this valuation, which is not ridiculous. So this move to me makes sense. I don't know how Carter feels technically, but you're through those prior highs. I think the stock can continue to go higher in the back of this quarter.
How do you feel technically?
Yes, well, as opposed to fundamentally or quantitatively or politically. But here's the reality. We know that this has been a major laggard, right? You're talking about a stock that its relative performance peaked to the S&P in 2020. And that's because it was such a massive outperformer during COVID when they were the provider of everything to everybody locked at home. It is a laggard that is only now playing catch up. I suspect this gap up has room to run. Once you clear a former high, in principle, as a matter of technique, you're in sort of free territory and you can move higher. There's no overhead supply.
Courtney, what do you make of the quarter?
Yeah, I think this is what you want to see when we're talking about these AI stories. You need to see that they're having the growth to go along with it. And I think the fact that you're finally seeing their cloud segment is actually growing faster than expected. People were worried that Google and Microsoft were really eating their lunch, and you're not seeing that happening. They're actually finally starting to accelerate. So this is exactly what you want to see in earnings report. When there's this big question of is AI in a bubble, you want to see them actually having something to show for it.
Right. That, and also the Prime subscription fees are going to go up in 2026. There's some operational fulfillment efficiencies which can be wrenched out of the system here. So they could actually pull the lever.
Yeah, I mean, one thing I'd say is that 17% year-over-year growth in AWS last quarter, if it had come below that right now, I mean, the stock would be down 13%. So, like, the fact that it's up 20%, that's great. So you're seeing a re-acceleration in that growth. You know, we've seen, like, the shifting fortunes as it relates to Azure and GCP from Google. I mean, those companies are growing their clouds faster, but AWS has more market share, right? And they don't, and we talked about this week. I'm totally wrong about that. I thought of all these names, this one was probably going to be the worst result. And, you know, I think the jury's still out, because you talk about from a margin perspective, that is what this company has been built on over the last 15 years, this mix shift between AWS and their core business. But, you know, and Mac just said this, that advertising business, which has been a monster, it's been pure margin. There is going to be pressure on that. I don't know if it happens. Maybe Gene can help us out later, whether it's, you know, Q1 2026 or Q4 or 2027. But that's going to be something that's going to be a problem as OpenAI and some of these other models look to monetize. They're going to do it through advertising, and they're going to do it with e-commerce. And I think that's going to be put pressure on this ad business for Amazon.
Yeah, I mean, Dan brings up the point when we've talked about it back and forth. This setting up was the worst setup. It turns out to be the best performer. We had it as a sell going into earnings this week. But again, it's always about sequencing. If this stock is up since the autumn of 2020, 30%, the S&P is up 100, and the NASDAQ 100 is up 150, is it a winner or isn't it? Meaning, this is good here and now, and if one has played it, okay, profits have been realized or there's more to come. But it has really been a disaster. There has been no alpha in Amazon for 4 years.
A disaster.
Well, it is. I mean, the numbers speak for themselves. I mean, if you're up 30% and an index is up 100 plus and a NASDAQ 100 is up 150, you lose. I mean, your money was not allocated to the right area.
Carter will tell you that if you went to a cocktail party this weekend and bragged to your friends that you're up 30% in Amazon, and they looked at you and said, loser. The broader market's up 100%. That's exactly right. So, yeah, you're happy with that until you see what the broader market has done, and he talks about the relative strength. It's been an underperformer. Now's the time, though, at least in terms of Amazon, where I think we play a little bit of catch-up.
All right. Yeah, I think that's a good one. I mean, people are sitting here wondering, like, I think a lot of people are like, Amazon, like, why Amazon? It's already so big. It's already $2.5 to $3 trillion company, and it's like, look, man, like, I get it, but I think at this point, it's when we were talking about Amazon back then, we were talking about a company that was trading at a much higher forecasted price to earnings, price to cash flow. And now we've gotten to a place where it's not getting those premiums anymore. It's getting a normal premium like Google. It's getting a normal premium, even a less of a premium than, say, Apple. And Apple, isn't growing to the extent, right? The only thing that Apple's growing in is potentially some margins and some service revenue. So, I don't know. For me, I think it's a no-brainer. It goes back to, what potentially can potentially happen with some of these things. And I think right now, if you look at it, I just don't think that you can flush out the multiples on Amazon like you can for an Apple, like you can for some of these other businesses. And I'm curious with this bear here. Let me pull it up in the background. I'm curious what this bear here, Gene Munster, has to say, particularly around Amazon and how Apple should be valued higher and perform better towards the end of the year. So curious. Let's pull this up, and hopefully Hot Steve will be joining us in a moment.
Gene, great to have you with us, and you've been on both of the calls. I don't know how you do it, but from Apple specifically, you're saying that they're being a lot more specific about things, which is a good sign.
Yeah, Melissa, if we go back to 2019, that's the last time they would give like really detailed iPhone guidance. And then, of course, during the pandemic, they pulled that. And then they kind of started to slowly give more guidance, but not to the product level detail. And here we are, they're giving more guidance, part maybe because they've got more to talk about. They're more excited to talk about double-digit growth. If you look at the iPhone, for example, over the June and the September quarter, and then you take their guidance for December, it's going to average to about 10% growth. Now, that compares to the iPhone being down over the previous 2 years, an average of 0.5% per quarter. And so I think, yes, we're seeing more color, and maybe from them just feeling that they want to tell a story because things are getting better. I guess it's neither here nor there. What matters is they're okay being more on the hook. I think it is a sign that they're feeling more confident about their business.
For Amazon, Gene, it's up 14, 15% after hours. Is that justified?
I don't know if that kind of move is justified. I think the piece that really is surprising people is that they're talking about this backlog. The CapEx side, just to kind of put it, I think it's important because that's an A topic. But the CapEx piece, they did mention the numbers, to put it in perspective, is about 6% higher than what the street had been thinking before. So that was the guide up in CapEx. But as far as kind of that move, it's in part because of that backlog comment, that their backlog is bigger for the December quarter than the revenue was in the September quarter. Of course, December is their big quarter, so that kind of makes sense. But that is really a bullish sign. I think the street's probably going to shake out to something in the order of 20-21% AWS growth for the December quarter. And I think that that's what's driving it. The simple takeaway is that I think Amazon has not performed that well. We're seeing a little bit of a recovery here. The results were solid. The outlook is solid. But I think that in its totality, there's better companies. I think Apple's going to significantly outperform Amazon from tomorrow morning, wherever they open, to the end of the year.
Wow, I like that.
What, the call?
Yeah.
It's a bold call.
Gene's the man.
Yeah.
All right, Gene, really quickly. So Amazon right now, if it opens here, it's going to gain, what, $200 billion in market cap. And, you talk about this Anthropic relationship all the time. A guy that I know is a brilliant tech investor, Josh Wolf at Lux. I think the other day he said, if I was a betting man, I'd bet that Amazon eventually owns Anthropic. Are we going to see M&A 200 billion plus? Okay, we just heard OpenAI or some reporting that they are targeting $1 trillion IPO at some point in the future. The numbers are getting kind of staggering. Do you think we will say any of these big incumbents make acquisitions like that in the private markets?
I think if I was going to say on a scale 1 to 10, the desire for Amazon to pay $200 billion for something like Anthropic is high. It's a 10 out of 10. I think they have to do that. They've got to add some substance to what they're building around AS and create some unique products that even pull in more AWS revenue. Google, Gemini, and Azure's been successful at that. The one piece, of course, is will the regulatory environment allow that big of a deal? I don't know the answer to that, but I do know that if you look around the table, there's not that many seats that have these large language models. You have Anthropic, you have Grok, you have GPT with OpenAI. So they're going to be highly sought after assets, and my sense is we're going to see some pretty profound M&A over the next couple of years.
Very intriguing. So I don't know if Steve's coming on. He told me 20 minutes ago, give him 5 to 10 minutes, and here we are 20 minutes later. So maybe he's setting up his stream or something. Let me just see in the background if I can send you guys somewhere. We got Hot Sam live. Steve is live in like 30 minutes. 15 minutes to go through tech earnings with Sir Amit Kukreja. So can't help but to say that he's probably just saying, Matt's useless, which I am. Let me actually wait until I need to go live. But what I will say is, for the time being, I'm impressed by Amazon, and I'm going to continue to buy. I think it's a great opportunity. I think it's a great place to put money. And I'm not saying go out and, put a crap ton of all your savings or anything into it. But I think it's a reasonable place that if you're looking for somewhere and you want to have it in the market and you want it to be safe and it's going to be growing. Now, it might not grow, let's say, like in the next year or something like that. But yeah, I think it's an opportunity for people to potentially say, hey, I think that Matt's right on this. I don't think that the e-commerce world, the AWS world, the AI world is slowing down, and I think Amazon's going to be a large part of it, and I think their advertising business is going to continue. You did hear some thoughts that CNBC Television brought up with respect to they think the advertising revenues, which is very much hitting their bottom line right now, might be challenged as some of these other chatbots and stuff come up to speed. So we'll see. We will see. I'm sending you guys over to Hot Tanner stream. Hopefully you guys go ahead and join in a quick second. Let's just see what he has to say.
Let's put that in. And boom, Bob's your uncle. We can add an extra decimal there to see that. And then let's also do that really quickly for...
So I just want to say I appreciate everybody stopping in here. And just want you guys to go over and check out my buddy Tanner. Let him know that I sent you guys. Really appreciate you guys being on here. Tanner is just absolutely phenomenal. His take on the markets are just phenomenal. So please go ahead, if you don't mind, and go and check him out. And I'll be over there as well. My food is about to hit the doorstep. It's about to hit 7:30 my time. I still need to get in my lounging gear for the evening. So appreciate it. And then in 10 minutes or so, Amit and Steve will be on as well. So might as well for a quick moment, give you that stream so you can have it on the background. I believe Tanner's been live for quite some time. So in that respect, who knows how much longer he's going to be. And so if you have the opportunity after to go watch Steve and Amit, why not? So I'd say open up both. So yeah, listen to this guy.
You can see the difference.
Look how
Institutional.
How articulate the guy is. How articulate he is.
$236 billion of volume traded.
Anyway, you guys rock. I appreciate you guys sticking with me. Head on over to Tanner. Let him know I sent you guys. And I'll see you guys soon. Cheers. Thank you guys so much. Love you. Bye.